Thank you very much, Baba. Shall we pray? Oh, let's get seated, but we just bow down our head. Our Heavenly Father, we thank you. The creator of the universe, we acknowledge your supremacy. We commit this morning's program into thy hand, and we trust by your grace and by your mercies, it shall be successful, and all the glory and all the honor shall be accorded unto thee. In Jesus' name I pray with thanksgiving. Amen.
Amen. Amen. So today we are going to talk about money, and this year's edition promises to be very engaging. It's going to provide a platform for us to knowledge share, but most importantly to network. And I believe most of us have spotted one or two people that we may want to speak to after the event. But I've also realized that after the event, people get lost, and we get lost in our excitement and all that, and we do not network. They say your network is your net worth. So I'm going to give us 2 minutes. If you've spotted somebody that you want to say hello to, if you haven't and you find someone sitting by you, just take a card, say hello, find out what they're doing, network for 2 minutes, and we'll come back and continue the event. Okay. Okay, I believe we know one or two people, and I believe we've done a very good job staying in touch, and I hope that we took some contact so that after the event, we continue to stay in touch. Now, this is the platform for discussing Ghana's. I can see that we are still networking. I'm going to give us 1 more minute, then after that, we'll come back again. Okay, I believe we are done now. Another minute? Are we okay? All right, please let's continue. So this is going to be a platform where we discuss the issues that are affecting our economy. Now, since 2020, the emergence of COVID-19 shook the world economy, and Ghana is no exception. And recently, the Russia-Ukraine war, as our president likes to reiterate, has also had a very diverse effect on our economy. So the Business and Financial Times has thought it wise to bring together thought leaders, to bring together industry players, to come and discuss ways that we can cushion our economy with or without the support of government. This event is going to be in 2 sessions. We are going to have the first plenary session, which is going to be discussing the topic from competition to collaboration, how fintech is shaping the future of finance. And then the second plenary session is going to be on the topic, Africa's robust securities industry, the role of insurance, pensions, funds, fund managers, and other market players. We are on Facebook, Instagram, Twitter. We are streaming live on Facebook and YouTube. So you can get the link on BFT Ghana, at BFT Ghana, on Instagram, Facebook, and Twitter. And on YouTube and LinkedIn, we are the Business and Financial Times. Now you can see we have a copy of our papers on the table, but then we are going digital as the world is also going digital. We are evolving, so we have our digital copy, and you can subscribe to it, and every morning, as early as 4 a.m., you're going to have a copy of the Business and Financial Times newspaper. You can subscribe by visiting our website, www.thebftonline.com, and then scroll down to the button. You're going to see our subscribe button. Just click on it, fill in your details, and then an attendant will get to you shortly. So we are moving straight to the event, but before that, a few housekeeping rules. Kindly, let's put our phones on silent or on vibration, or we can turn it off if possible. If you want to visit the washroom, please see any of the protocol team out there, and they will direct you to the washroom. So we are going to take our welcome address, and this is going to be done by none other than the Chief Executive Officer of the Business and Financial Times, Dr. Godwin Akwe. Please, let's give him a round of applause as he joins me up here.
A very good morning to all of us. Good morning. Mr. Adomaku, the MD for GCB PLC, Ms. Abna Amwa, Managing Director, Ghana Stock Exchange, Mr. John Ewa, CEO, Ghana Association of Banks, Mr. Bennett, CEO, UMB Bank. The list goes on and on and on. All protocol observed. A very cordial welcome to the Money Summit 2023. We are very glad to be together again this year to collectively stimulate workable ideas in support of government's effort to get our severely challenged economy back to life. The theme for this year's summit is Africa's robust financial sector, the catalyst for a sustainable economic growth. The financial sector is key to the growth of the economy. It is capable of efficiently allocating resources, assessing and managing financial risks. Globally, the financial sector is going through challenges, and we are all feeling its pinch in our pockets and budgets. The 2023 financial year has been given a challenging one, has been a very challenging one in every sense of the word. Inflation is hovering around 45%. The commercial bank lending rates is around 30%. It was already clear that the ravages of the COVID-19, the costly impact of the war in Ukraine have had a devastating impact on our economy. And now the recent debt exchange program is greatly affecting banks and businesses. About a week ago, we had 17 of our banks posting losses. The challenges have rekindled the pre-existing structural and macro-fiscal vulnerabilities that are currently testing our economic resilience. Dear partners and friends of the Business and Financial Times, the Money Summit seeks to enhance investor confidence and bring together actors in the financial sector to provide solutions that will or can anchor investor confidence in our economy, as well as ease the hardship and challenges of businesses and the average Ghanaian. Distinguished ladies and gentlemen, as Ghanaians, we are faced with a glaring opportunity to pull together in a bid to restructure our economy from a service-driven one and instead build a robust and resilient one through technology, finance, investment, trade, and entrepreneurship. Our exchange rate volatility is contributing largely to the uncertainty and lack of confidence in the economy. This, we all know, is mainly systemic, as our imports far outweigh exports. With the high depreciation of the cedi, some Ghanaians have changed their tastes from foreign to local goods. This is an opportunity for government to create that enabling environment for the creation of import substitution industries to reduce our high levels of importation. This will also reduce our increasing unemployment figures. Distinguished ladies and gentlemen, if you are fortunate today to have some money after consumption, which investment vehicle is preferred? Which financial institution is safe? These are some of the questions we want answers to today. I look forward to a comprehensive discussion and framework which we can present and advise government and influence policy. Ladies and gentlemen, I wish all of us a good deliberation. Thank you.
Thank you very much, Dr. Godwin Akwe. Please let's give him another round of applause. At this point, I would like to acknowledge our sponsors and our media partners. So we have Stanbic Bank, Asa Finance, and FBN Bank. Please, let's give them a round of applause. Thank you so much. And for our media partners, we have Global Media Alliance, ETV Ghana, Happy FM, Asasi Radio, City FM, Seta TV, TV3, and Onia FM. Please, let's give them a round of applause too. At this juncture, we'll be taking our keynote address, and this is going to be done by Ms. Abna Amwa. I'm going to read a brief profile of Ms. Abna Amwa before she joins us up here. So she is the Managing Director of the Ghana Stock Exchange. She has worked in the capital markets industry over the past 24 years, and she is highly respected for her technical knowledge, business acumen, outstanding professionalism, and integrity. Her experience covers stock exchange, stock market listing and trading, mergers and acquisitions, investment research, asset management, private placement of equity debts and hybrid instruments, large infrastructure project development, business startups and incubation, public education on investment and financial patterns, and then capital market development. Ladies and gentlemen, she has previously worked with the Black Ivy Group, LLC, Renaissance Group, where she was CEO of the New World Renaissance Securities Limited and Head of Investment Banking and Finance in West Africa. For Renaissance Capital and Strategic African Securities Limited, where she was Executive Director. She is an alumna of the University of Ghana Business School. She has also undertaken academic and leadership studies at the Stanford Graduate School of Business, Harvard Business School, and the University of Denver's Daniel College of Business. Ladies and gentlemen, with such an amazing profile, please help me welcome Ms. Abna Amwa to give us the keynote address.
I got exhausted listening to that. I'm just Abna Amwa. Distinguished ladies and gentlemen, Dr. Akwe, the BNFT team, my directors, captains of the financial services industry, management and staff of BNFT, distinguished speakers and panelists, ladies and gentlemen, good morning. I begin by commending the BNFT for organizing this third edition of the Money Summit. The Ghana Stock Exchange takes pride in association with this event for 3 consecutive years. We believe that this platform is vital for discussing pressing issues within the financial sector and contributing to the dialogue that shapes its policies. This year's theme, Africa's robust financial sector, the catalyst for sustainable economic growth, is timely given the current global and also very domestic challenges and financial difficulties faced not just by Ghana, but the continent as a whole. We find ourselves, ladies and gentlemen, at a critical juncture in our history. Are we going to waste this crisis? Or are we going to take this moment that is filled with great challenges, but also immense opportunities, and turn it around for ourselves? It is imperative that we explore the potential of our financial systems as catalysts for progress, prosperity, and sustainability. It is therefore with great pleasure and a sense of optimism that I stand before you today to address this topic of utmost importance: how a robust financial system can catalyze Ghana's sustainable economic growth. Distinguished guests, allow me to highlight a few key areas where a robust financial system can drive sustainable economic growth in Africa. One is about mobilizing capital. Access to capital is vital for entrepreneurs, businesses, and infrastructure development. A robust financial system provides a platform for efficient capital mobilization, allocation, and investment. It facilitates the flow of funds, allowing businesses to expand, innovate, and importantly, create job opportunities for our very young populations. By nurturing entrepreneurship and supporting the growth of our SMEs, we can foster economic diversification and reduce reliance on our traditional sectors. A healthy ecosystem of banks, capital market players, insurance companies, pension funds, and other financial institutions will create an environment conducive for growth, innovation, and shared prosperity. Do we have that ecosystem? And what do we need to build, to put in place to strengthen it? Second is enhancing financial inclusion. And there I note that we've come a bit of a ways there. A strong financial system ensures that everyone has equal access to financial services. Whilst a significant proportion of our population remains underserved or unbanked, by promoting financial inclusion through innovative technologies and inclusive policies, we can empower our individuals, particularly our SMEs, our women and marginalized communities, to participate in the formal economy. Our pride of saying we have such a huge informal economy, we need to start looking at how we bring more people into the formal economy, because this unlocks potential, stimulates consumption, and drives economic growth from the grassroots up. And I dare say with almost 240,000 mobile money agents, we have seen how the grassroots development is promoting financial inclusion here. The third area I want to talk about is promoting trade and investment. We possess vast potential for intracontinental trade and foreign investment. A robust financial system facilitates cross-border transactions, mitigates risk, and provides necessary financial instruments. Strengthening our regional integration and promoting trade finance mechanisms will unlock opportunities for business and enhance our competitiveness. The African Continental Free Trade Area, with its ambitious goal of creating a single market, provides a platform for collaboration and integration. By leveraging this trade area, businesses can tap into the vast potential of a market comprising 55 countries, a population of 1.3 billion people, and a combined GDP of over $3 trillion US dollars. It is through such partnerships that we can drive innovation, enhance competitiveness, and accelerate growth across Africa. Cross-border trading and investments are crucial, and that is why initiatives such as the African Exchanges Linkage Program and collaborations between organizations like the African Securities Exchanges Association, of which the Ghana Stock Exchange is a member, and the Pan-African Payments and Settlement System, PAPS, are breaking down barriers, enabling seamless cross-border transactions, and enhancing the efficiency of our financial markets. And I'm very happy to also announce that GCB Bank recently undertook a PAPS settlement transaction, and we applaud you for that. The fourth item I want to talk a bit about is fostering innovation. Innovation is the lifeblood of economic progress. A well-functioning financial system provides a nurturing environment for innovation and technological advancement, enables the growth of fintech companies, supports digital infrastructure development, and promotes the adoption of emerging technologies. By embracing digitalization, we can drive financial inclusion, improve efficiency, and unlock new avenues for economic expansion. The final one I want to talk about is promoting sustainable finance. Ladies and gentlemen, addressing environmental and social challenges is essential for long-term economic sustainability. A robust financial system can incentivize and channel investments towards green projects, renewable energy, and sustainable initiatives. By promoting responsible investing, ethical banking practices, and the integration of environmental, social, and governance considerations, we can create a more sustainable and resilient economy that benefits present and future generations. Recognizing the importance of promoting sustainable finance, the Ghana Stock Exchange took a momentous step forward in 2022 through 3 key initiatives, namely, 1, becoming a United Nations Sustainable Stock Exchange member. 2, we established our sustainable market segment and launched our green and sustainable bond rules. And finally, we launched our ESG reporting guidelines. Ladies and gentlemen, to achieve these goals, collaboration among us is paramount. Governments, regulatory bodies, financial institutions, private sector entities, and civil society must all work hand in hand. We need to foster a culture of transparency, integrity, and accountability. By strengthening governance frameworks, enhancing risk management systems, and promoting ethical behavior, we can build a financial ecosystem that commands trust and attracts investment and stands the test of time. In conclusion, a robust financial system is the bedrock upon which we will change our economy so that we flourish. It enables capital mobilization, it drives financial inclusion, it promotes trade and investment, fosters innovation, and supports sustainable development. Distinguished guests, I have great confidence in the team of experts assembled by the BNFT for our 2 plenary sessions today. Their valuable insights and perspectives will shape policy discussions that are essential for supporting the growth and development of our country and continent. I extend my best wishes for a successful event, and may the outcomes of this summit contribute to a brighter future for Ghana, Africa, and its people. Thank you.
Thank you very much, Abnamwa. Please, we can do better than that. Let's give her another round of applause. And then I'd like to acknowledge our sponsors once again. We want to say a very big thank you for putting this together, for giving us support, and for being here today. So, GCB Bank PLC, thank you so much. We are grateful. Stanbic Bank, Asa Finance, FBN Bank, thank you so, so much. And to our media partners, Global Media Alliance, City TV, City FM, TV3, Onia FM, Asasi Radio, and Happy FM. Please, let's give them a round of applause. We are going to take a brief presentation from Mr. Eric Kweku Mensah. He is the lead financial crimes and anti-money laundering at E-Crime Bureau. He is going to give us a presentation on the financial crimes and anti-money laundering. And also Glyco, Glyco, thank you so much. They are one of our sponsors. We are grateful. Please, let's give them a round of applause. Thank you, Glyco. Mr. Eric, please, you can join me here.
Hello, good morning. Okay, you can put my slide up. Yeah, sure. All protocol observed, and a very good morning again. Thank you, BNFT, for the invite. Okay, great. Thank you very much. So, in as much as we talk about the innovations around the financial sector, it's very important that we look at one critical aspect, which is the risks of financial crimes and cybersecurity. And of course, spare me some few minutes to take you through what we have seen within the ecosystem within the past few years. Okay. Okay, that's fine. So, the screenshot you are seeing over here is a screenshot from the dark web. Now, this came up in February this year. And of course, this is very confidential, so some of the information have been redacted. Now, what is happening on the screen? Some criminals have been able to hijack a fintech organization in Nigeria. And I'm sure those who are within the intelligence domain might have heard about what is happening. And it's actually been offered on sale in the dark web. The initial offering price was $50K US. In fact, as at 7th of February, the guy who won the bid offered $250K US. Now, I am saying this to draw a point. The next one, please. I think the pointer is not here. This is also something that happened pre-COVID. Some criminals were able to hijack Cosmos Bank in India, and they were able to get over 14 million USD within the space of 2 hours, 13 minutes. In fact, per investigations, they actually were able to redraw over 12,000 single ATM transactions in 28 countries. Now, these are the issues that we are facing and are likely to face in the future, if not even more, when we don't put in proper risk management systems in place to safeguard the little that we have. Kindly, okay, so you can still go ahead, yes. Move again. Again. So globally, some countries have taken very giant steps. This is a screenshot from the Dubai, working with banks and financial institutions to mitigate financial crimes. Yes, sir. Okay, good. Also, the US in March had to invest $500 million US to mitigate financial crimes. Morocco and Libya also doing their bit. This is also something that came up just last week. UK has actually come up with a fraud strategy, stopping financial or stopping scams and then protecting the public. In fact, this strategy had 3 pillars. And like you can see on the slide, we have one which is the pursuing the fraudsters, 2, blocking the fraudsters, and then also empowering the public. Now, as we talk about Africa's robust financial system, it is very important that we put in certain critical strategies, both from the regulatory point to the corporate entities like the financial institutions, and then the accountable institutions that are seated in here, and then even putting in strategies for the normal consumer that is on the grounds. How are we protecting them from these miscreants that are likely to target them with these financial crime schemes? Next, please. Yes, of course, you can't see the slide very well because of the projection, but this is just a snapshot of some of the risks that we are facing within the country. And of course, some of them, you might have heard of them. We have cyber-dependent crimes, and then we have seen some metamorphosis of the traditional crimes that we all know of. Let's say document counterfeiting. Yes, it has been in existence for long. Currency counterfeiting has been in existence for long, but we have seen that with the advent of new technologies and even AI, these criminals are doing a lot to be able to prey on organizations. So these are just some few schemes. Okay, you go forward. I think let me dwell on Ghana specifically and then look at the best practices, then we are done. So this graph shows fraud within the country from 2016 to 2021. This is a collation of Bank of Ghana's financial crime statistics. And you can see that in 2018, it went extremely high. 2020, during the COVID, it also went extremely high. And I must say that in 2021, the loss amount was the highest, which was 61 million Ghana cedis. So we have to do certain things to be able to mitigate some of this risk. Next slide, please. Okay, so before the best practice, there were some major vulnerabilities per analysis from E-Crime Bureau that we actually came up with, or we saw. One is the onboarding challenges within the financial institutions. So there are some gaps in onboarding. And of course, we are all in this country where there were issues around even identity theft, ISM registration, and the rest. The other one is the internal control and compliance lapses, technological gaps, governance-related issues, and then, of course, the last slide, which we can see, is the awareness. Because sometimes you do investigations and you realize that there are certain basic phishing schemes that staff of institutions are not able to identify. And, of course, these criminals use these schemes to be able to commit the bigger crimes that we are seeing. Next slide. Okay, so this is the emergence of cyber gangs. Of course, criminals are now not operating like lone rangers or sole proprietors. No, they are a gang. And of course, per our intelligence, they use insiders. So they'll use any means to be able to get insiders of either the financial institution or any organization that they need to, prey on to be able to commit their crimes. Okay, so the next one. From the regulatory point of view, what we are saying is that, of course, we have nice laws. So it's very important to enforce the regulations. The laws are so fine on paper, but when it comes to enforcement, at least there's more room for improvement. There should be greater collaboration with law enforcement agencies to share information. And that is something that we have seen. And I know the bankers in here will know about this. Lack of information sharing is causing big problems within the ecosystem. Providing training and guidance to financial institutions. Investing, okay, so for the corporate organizations, it's important to invest in cybersecurity and financial crimes management because, of course, you are doing your best. You are rolling out the wonderful products, innovative products, but when you don't input or you don't roll out some cybersecurity management protocols in place, I tell you, you might do your best, but all the funds will just go down the drain. Also, adhering to industry regulations like the Bank of Ghana Cyber Information Security Directive, development of effective fraud risk management programs, establishing strong security posture, background checks, which is very key. Background checks is very key. Using intelligence approach to stay proactive, and then also implementing strong AML and CFT regimes, and then also developing very, and implementing very good policy. So, in a nutshell, this is what we have to share today, because, sharing this would also inform some of the innovative strategies that we want to put in place, and then the product that we want to roll out. Ladies and gentlemen, I must say a very big thank you to BNFT for inviting us again for this very important occasion, and very good morning to all of us. Thank you.
Thank you very, very much. At this point, I will be inviting Mr. Kwame Opon. He is the head of FinTech from the Bank of Ghana. Please, let's give him a round of applause as he joins us up here.
Thank you very much, and good morning once again. I stand on existing protocol. Now, that was a very scary presentation that you just saw, wasn't it? But this is the reality. I think what he presented to you is the reality of what the future could look like should we not put the right mechanisms and modules in place to safeguard the ecosystem. I think we have to accept a few things. One, the fact that the financial sector, and in fact, society is moving digital, is done. The jury is in on that. So, as you can see, whether banks, fintechs, or everyone else, that acknowledgement is there. Secondly, we also have to come to terms with the fact that it changes the dynamics in terms of competition, competitors, actors, and even more importantly, the role of regulation and supervision. Now, we are also having to take a look internally and at ourselves to understand what this means for us to be able to continue to preserve our mandate. I'm sure you hear of the plethora of mechanisms and initiatives and policies that we put in place, but it's to ensure that we're still able to enforce and uphold the mandate that we have. Nonetheless, there's a healthy conversation that needs to be had on two levels. One, how industry collaborates to ensure we have progress, while at the same time recognizing that competition is still there. So it's nice to see a table seated with frenemies, friends in some instances, enemies in some instances, but this is healthy for the overall progress of industry. The consumers have voted with their feet. Many banks now are demonstrating clearly that it is more viable to build a business where consumers are giving more choices when it comes to digital financial service options. And we hope to see more of it. Now, I'm lucky to be one of the few regulators with the opportunity to both supervise, but at the same time also promote this idea. And so that's why often you see us wearing two hats, and I'm sure the fintechs are not always happy about the other hats, but it's important, as you just heard. The case he showed in Nigeria is something we also track, and internally we see what's happening. We try to see what's happening in the dark web and all these other areas that often you do not want to hear about. But our primary goal is to make sure the sector is safe, the industry is stable, and we can indeed support the advancement of it. So really, I'm looking forward to the broader discussion today. I hope we can get some real good insights that can help us as regulators also understand how we can help industry safely build the digital financial service ecosystem. Thank you very much.
Thank you very much. And like Mr. Kwame Opon, I believe we are all looking forward to the broader conversation. So we are moving straight to our first plenary session, and this is going to be on the topic from competition to collaboration, how fintech is shaping the future of finance. And I'm going to be calling our panelists to join me up here. So Mr. Kofi Adomako, he is the Managing Director of GCB Bank PLC. Then we have Mr. Nanayao Owusu Banahene. He is the Country Manager for Aza Finance. Please join me up here. And then Miss Marianne Amate, she is the head of business enablement, Stanbic Bank. Please join me up here. Then Mr. John Ewa, he is the chief executive officer of the Ghana Association of Banks. Please join me up here, Mr. Ewa. And then Mr. Alan Kwe, he is the head of retail banking, FBN Bank, Ghana. And finally, Nana Jomo Bene, he is the CEO of UMB Ghana. Our moderator for this session is Richard Nunekbeku. He is the Vice President, Legal and Strategy at the Ghana FinTech and Payments Association. Mr. Richard, please join me up here.
Hello, good morning, everyone. Thank you for joining us, and for those who are listening to us via all digital platform, good morning to you. Some centuries ago, the first bank opened its doors to customers in Ghana. From then, the way banking and financial services has been delivered in this country has tremendously changed over the years, driven largely by innovations and technology. Today, we are at the intersection of concern and excitement about how fintech innovations are shaping the future of finance. And I'm excited to be joined by a team of experts who will be helping us understand how banks and fintech companies must either collaborate or compete to shaping the future of finance in Ghana. And on that note, I want to thank all my panelists for agreeing to be with us this morning. And I want to start right away with Alan and Miriam. The discussion about fintech has been very dominant these days in terms of financial service delivery. To you, Alan, what does your bank, FNB, perceive fintech to mean? And what are you doing internally to leverage the innovations that we are seeing today?
Okay, so at FBN Bank, of course, we recognize fintechs as partners in our business. Fintechs, as we know, are businesses that are providing financial solutions using technology to a very large extent to drive products, to drive wealth creation, to provide financial support, to provide payment platforms, to create convenience, and also, among others, lower the cost of banking. We are collaborating with fintechs to be able to deliver what I've just spoken about, so that at least the bank stays competitive, the customers get their needs met at a lower banking cost, and also to drive innovations. In creating a unique, innovative, relevant product as banks, we've realized that we cannot do it all by ourselves. We will need to collaborate with fintechs to be able to take us far. And in that regard, we work with them, because by working with fintechs, you are able to extend your coverage, you are able to develop more products, you are able to reach out using various means for your customers to be able to undertake their banking needs, among others. So it has been good with regard to dealing with fintechs, and we believe that it is the way to go. It has come to stay. We will work with them. Unlike in the past when we saw them as useful disruptors, this time we see them as collaborators, and we'll continue to work with them, very much guided by the banking Act and, of course, the policies that our regulator wants us to work within. Thank you.
And to you, Miriam, specifically, what is Stanbic doing in terms of leveraging these fintech innovations?
Thank you, Richard. First of all, I want to thank you for moderating this session, and also to thank the BFT team for putting this platform together. There are a couple of toolkits that we are leveraging as a bank. The first one is API, Application Programming Interfaces. It's basically to enable open banking. Why are we doing this? Is to ensure that we open up for third parties to add on solutions to our banking platform. And if we have to be agile, it's quite important that we open up and ensure that we allow third parties to integrate with our platforms. The other thing that we are also leveraging on is robotics, to ensure that we enable a self-learning tool within the business and also for our customers, and also to automate repetitive tasks that ensure that we create a very great customer relationship management when it comes to using our platform. The third one I want to touch on is AI personalization. That is riding on data to ensure that we understand the trends of customers and the likes in terms of what solutions and platforms would help enhance their business. And that is why we believe that being with the fintechs and dining with them at this point is quite important for the bank. Thanks.
Thank you. Nana, you recently was 50 years, and happy anniversary. So over the years, how has UMB responded to innovations over the years, and how are you prepared to respond to the new challenge?
Well, thank you very much, Richard, and good morning to everybody. I think that one unique selling point for UMB over the years is a very deep understanding of its customer and what the customer requires. And so over the years, we've found ourselves at the forefront of innovation as a result of the customer demand that sort of came along. So I'll give you an example. In the 90s, for example, we were one of the first banks that started bill payments for ECG, Ghana Water, where people could walk into branches to pay. Now it looks like it was one of the most archaic ways of doing it. But then it was an innovation. And why did that come about? Because the customers were looking for ways of improving their cash management. Money transfer, long before a lot of the money transfers came, UMB was doing Vigo. Again, it was because it was driven through customer demand, and the customer sort of drove us into the innovation for those sort of things as well. So that culture has stayed with the bank as the bank has grown, and now at its 50 years. And this is quite an exciting time, because what we actually find, especially post-COVID, is there's a lot of use cases that are being created out of what the customers are asking for. And that's sort of putting us on our toes to be able to provide these for customers. And that's also leading us into this new area of collaboration. No long ago in business school, I learned about a word, co-opetition. And it was a very academic word at the time, where you have competitors who are collaborating with each other. But as our world has evolved, co-opetition has now become the reality. Not only are we having to collaborate among ourselves as traditional banks, but we're having to collaborate with fintechs who we bank as our customers, and we also sell similar products and services to. And that sort of new construct in the world is what is now encouraging a lot more collaboration as we bring products and services to our clients.
Thank you. Mr. Kofi Aduma, we all realize that with the advent of mobile money, the customer preference of use of financial tool was changing, and GCB took the bold initiative to launch G-Money. Being a traditional bank and also operating a fintech innovation, how has been the market reaction to G-Money, And what are some of the barriers to adoption and conversion the bank has identified since its rollout?
Hear me? Can you hear me? Can you hear me?
Yes, we can hear you. Yeah.
Brilliant. Thank you very much for your question, and also to BF&T for inviting GCB to be a part of this. We at GCB find events like this extremely useful. As you rightly said, GCB being a broad-based bank, widely spread over the country, found it very necessary as part of complementing our own customer value proposition to introduce the first bank electronic wallet, mobile wallet, as a bank, and that was G-Money. And G-Money has been phenomenal. It's been extremely successful. Not to say it hasn't encountered challenges. There have been many challenges, but it's been extremely successful in the last 2-3 years that it was established. It came into being to fill a gap. It came to resolve a solution. It's both telco and bank agnostic. And so it served a very a good purpose for our customers and non-customers of the bank. The adoption has been very interesting. We've seen rapid growth. We've seen a bit of it plummeting as a result of a number of things. I think one of them was the challenge of e-levy brought its own challenges to the adoption and rate of G-Money. But generally speaking, it's being very useful for our customers, very useful for non-customers of the bank as well. We're very widespread. We're in areas where banking is very limited, channels are very limited, and we've used G-Money to penetrate some of these areas, bringing financial inclusion and also bringing financial services to people in, as it would be, the rural areas or who are out of areas where banking is. And as you know, banking is changing very rapidly. Technology at the helm of affairs. We lead in branch network in Ghana, but it's not going to be the thing into the future. So digital platforms are going to take over. Technology is going to drive. So I think we've pushed G-Money in the right space, and the future looks very bright, and that's where we should focus.
Thank you. To Mr. Banahini, we all acknowledge that there are two key players driving the change we are seeing in the financial sector: traditional banks and fintech companies. For you as a finance, where do you put yourself? Are you a traditional financial service provider, or you are a fintech company? What is your offering to the ecosystem?
Hello. Thank you very much. I think it's an easy question to answer. We are a fintech company. We are not a traditional bank, but banks can also be some level of fintech also. ASA is operating in 115 countries, and our core focus has been on payments and treasury. And one of the things we've been doing in all these markets is working with licensed partners like banks and PSPs, because we believe in collaborating within the ecosystem. Our business model is always B2B. So we always want to work with a partner to deliver the last mile services. So to answer it very shortly, we are a fintech company providing these key services in 115 countries.
Thank you. Now, to Mr. Ewa, when the conversation of fintech started, the narrative has been its disruptive nature. So as an association of banks or bankers, what are some of your major concerns towards the adoption of fintech innovations?
Thank you very much. The verdict is out there. The trajectory of traffic in the financial system is gradually moving more in an accelerated mode into the digital arena. So you either play or you plan to fail going forward. So as community of banks, and as you have listened to my colleagues on the panel here, it's been more of how do we work very well with the ecosystem safely. So as banks, our key concern has been a situation similar to what was described by our friend from E-Crime Bureau. Collaborating with fintechs means in a lot of the instances opening up your infrastructure to third-party entities. As banks, we are heavily regulated. Some of the things we do, if you leave to any ordinary business, may not make sense to the business to do that kind of investment. But as a bank, you do not have a lot of choice when it comes to directives and things that are driven by the industry regulator. We do not necessarily have that kind of mechanism playing out within the fintech environment. And in that environment, you are likely to find one or two people in a boutique office somewhere running volumes of businesses. These volumes of businesses, incidentally, comes through the financial infrastructure. As bank, you are as secured as the weakest link to your infrastructure. So we can protect as much as possible our architecture as a banking industry. But to what extent are the people who are plugged into our environment also ensuring that kind of safety of transactions within that system? One key thing is, and that's exactly what, as players within this environment, we must all take cognizance of. That is, the financial system rides on trust and confidence. The moment you have the semblance of what was demonstrated in a short while ago, feeding through the ecosystem, there's that propensity of people then drawing back because of concerns around safety. So it is important, and that is why I say it's not a matter of concern, it's more of how do we work well together to fortify players within the system in a manner that it does not disincentivize banks or other players linking up and opening up their infrastructure to third parties. The second one is on regulation. Now, we are more or less chasing the same customer. Most of the fintech environments are mass market driven. They have products that can, in a matter of launch to another 1 week, is moving from Accra to Savulugu to South Tong to wherever. So it's mass market driven. And in these areas, I can understand where Bank of Ghana can find it a little bit challenging, balancing regulation in a manner that it does not stifle innovation, and also making it in a manner that it is safe to conduct business in the environment. So we do not want, given that we are chasing similar customers and we are highly regulated, for one side of the regulation to be a little bit relaxed because of the terrain, and in another side, for the regulation to be so stringent, such that we struggle to reach the same customer for the same business when an entity that is within the ecosystem do not have to go through that regulatory kind of hindrances in order to reach the customer. So speed to the customer is then facilitated by regulation in some instances, and whereas we as banking practitioners, we have a little bit of constraints on how we can reach the customer in that same kind of speed.
I appreciate that. And as a follow-up to you, Mr. Ewa, so then what is the best model for collaboration between the banks and the fintech companies? Because you said you are all looking at the same customer. So how do you collaborate to reach the same customer?
Yeah, my colleagues have already, spoken quite well about that. They've talked about collaborating, but collaborating can come in several forms. Partnership is one of it. One key strength of fintech organizations is their agility, their ability to anticipate customer needs faster, act faster, meet the customer faster, because they are very little internal constraints in terms of policies. For a bank, sometimes you have to go to your group office in order to get a product out in the market. So partnership will be one key area where the bank will ride on the back of the agility of the fintech, and the fintech will ride on the back of the bank's strong infrastructure, so that the two together can work to drive value to the customer. The other one is acquisition. You know, we are banks, and if you read financial articles, in another decade, banks will become big fintech organizations. I mean, that view of I'm going to my bank branch gradually will be waning off. Palace-looking bank branches will begin shrinking to, boutique bank branches where perhaps you go and you see one or two people and a lot of computers for you to do your transaction and go, be your own banker and transact and go away. So to do this, banks may, because of the agility, again, of the fintech organization, may strategically decide and target some fintechs that may not have the financial wherewithal to invest in infrastructure and maybe acquire them, maybe hook, line, sinker, take them into our infrastructure and help capitalize them to drive our financial products and services to the customer. And the last one, which I can think of right now, is investing. The fintech proposition is a very profitable proposition. Most of them do not have the financial muscle to invest in the key infrastructure they have to do in order to transact, to drive the volumes that are out there to attract. So as banks, we can strategically also invest in some of these fintechs, give them the financial strength to do the right thing, because by them doing the right thing, they are contributing positively to the ecosystem. And in all the things that we do, like a financial literacy campaign, they can all join with that drive because they have the financial resources to contribute towards an activity such as that. So I can think of three. I'm sure there are other modes of collaboration.
I will be posing the same question to the other banks here. So to you, Nana, Mr. Wah from the association perspective is asking for three things: partnership, buyout, and investment. Do you share that view? And what specifically is UMB doing currently in terms of bringing fintech innovation to the banking space?
I can say Mr. Wah has aptly demonstrated his CEOship of the association, because, I mean, his points are spot on. So if you think about us in UMB, what we are doing is that, the financial services world is very multifaceted. There are many things happening, and there are many products and services serving. All this is migrating into, if you like, the online world. At the moment, we as banks have a captive audience of clients. Fintechs, in most cases, are starting, and these are that captive audience. We also want to make sure our customers stay within our fold. So the solution is, why don't we collaborate so that the customer has access both to us and to the fintech in one place where they can transact and we all share. So in UMB, we launched what we call banking as a service, which allows fintechs to come in and plug in onto our system. Their products are there, our products are there. Customers come to that marketplace online, and they have access to our products and their products. So even though we are competing, the products are together. It's an aggregation of service so that you make it easier for the customer to access. The other thing that is really good about it, and Mr. Wan mentioned it, is we are obliged as banks to do ISO certification, PCI DSS. All those certifications cost a lot of money and a lot of investment. For a fintech who has a wonderful product that has come into the market, they may not necessarily have that investment dollar to build all that infrastructure, or actually it's not actually necessary for them to build that infrastructure. We collaborate, they sit on our system, they are certified through us, and as a result of that, their business also starts to grow. And we are seeing more and more fintechs coming to plug in onto our system, which is allowing our ecosystem to be enriched. And through that enrichment of our ecosystem, we are keeping the customer's attention. And finally, there's a lot of talent when it comes to fintech and fintech development. In fact, I've seen reports that are directly investing in the fintech. So again, here, we do partnerships and collaborations where we have some of these funds that can be helped to be used to develop more of these fintech solutions. And in UMB in particular, we are very, very focused on the SME and developing products and services that fit the SME sort of market as well. So we find exciting opportunities to do these things.
Okay. Then, Alan, FNB, do you take the same view? And sorry, FNB.
FBN.
Sorry, FBN. Sorry, FBN. Do you take the same view? And are you pursuing similar initiatives?
Okay, so I take the same view. And at FBN, of course, yes, we've realized the relevance and importance of fintechs. In our parent company, located in, of course, Nigeria with 120 plus years, we have in our system, ecosystem, our own incubators, our own innovative hubs, where we are able to provide digital platforms and solutions to our various needs. In terms of products, in terms of processes, in terms of systems, among others. That also is additional to working directly with third-party fintechs to be able to reach our customers and give them relevant platforms that addresses their needs as well. So of course, at our bank, yes, mindful of the customer, they being first in our business, we are using fintechs both within and outside the bank's ecosystem to be able to take our products beyond our network, take it online, provide more relevant solutions, make banking easier, make it more convenient, make it less expensive, but at the same time, make sure that at least whilst we invest in these things, the banks also make good returns on such investments placed on the incubators that we have, the technology hubs that we have, in addition with working closely with third-party fintechs.
Thank you. And Miriam, I know Stanbic, for instance, has a Stanbic incubator program as a way of bridging the gap between the bank and fintech companies. What other initiatives is Stanbic currently rolling out or planning as a way of making sure fintechs get to leverage your strength as a bank to deliver their services?
Okay, I think I share in the same view already submitted, and I'll just add 2 comments to that. Also in the area of partnership, one thing we are doing is to ensure that we partner along the value chain. So we don't just bring you on board because you're a fintech, but we look at the areas of, for example, payment, credit, lending. So if there's any fintech here who has that skill, it's important that you reach out for us to see how best we can enhance the relationship. I guess when it comes to the incubator, one area the bank is also looking to enhance is identify local fintechs who has the right skills and has the potential to grow and give them the space to innovate and see what we can achieve together, as partners. So I guess just to support what my panel colleagues have shared, we are aligned in terms of what we want to achieve, as partners when it comes to fintech and banks. Thanks.
Mr. Adumako, the McKinsey and Company in 2022 estimated that the Ghana fintech revenue will reach $18.6 billion by 2025. Whilst we are excited at that potential, what do you think will be the key drivers to helping us achieve those numbers?
Yeah, very good. It may seem an aggressive number, 19 billion, which is about 33% of GDP. It may seem aggressive, but it's actually achievable if we continue to do the right things. From a national perspective, we continue to seek and implement policies that seek to drive a digital agenda. Banks, as you've heard very clearly, are in the mode of collaboration. Okay? Banks are in the mode of collaboration. If the regulator is also able to support all of that collaboration, such that innovation is also kept alive, and if government through policy can put the necessary policies in place to ensure that the digital agenda is not compromised, then I do not see why. Already, if you look at what mobile money payments are doing, they are way ahead of traditional banking payments. Transactions and in value, they are way ahead. So 19 billion may seem a huge number, but given the manpower that this country has, the youth that we have, their savviness around technology, the introduction of the Ghana card, registration of SIM cards, we're moving into a very organized ecosystem of digitization. And it should create an opportunity for fintechs and banks to leverage on. We in GCB have taken our G-Money company out of the bank, and it's sitting as a business on its own. And there are very good reasons why we are doing that. And it's the future. It's the lifeblood of GCB. Despite the challenges that the industry has had in the debt exchange program, I think banks have decided, banks still stay strong. Banks have decided to move forward. What we are looking for now is solutions and how to change banking, because the field is changed. Huh? The topography has changed completely. With the debt exchange program, with technology, we have to find ways of doing things very differently. So I won't doubt it. That the total revenue in the fintechs bucket can be about $19 billion. It is real, and it's an opportunity for all of us to take advantage of it and make it really happen.
Thank you. Now, Mr. Banahini, one of the outcomes, if we should attain the $18.6 billion revenue, will be increasing financial inclusion. One of the outcomes will be increasing financial inclusion and bringing the unbanked population into the banking sector. What do you think will be some of the toolkits that fintech offers as an opportunity for driving that financial inclusion that we all desire?
Thank you very much. I think the future happened yesterday, and some of the things we're talking about are already happening. The banks and with the fintechs. Just to give some level of data, in terms of financial inclusion in Ghana, the biggest topic has been mobile money, right? And it does not cover all financial services. In a way, it's driven payments and transfers. Cash in, cash out. People can do cash in, cash out, and transfers. Now, in terms of disruptiveness, between 2006, in Ghana between 2006, 2008, 2009, we were doing transfers into the country around $1 billion, right? Sorry, I guess, Mike. Hello. In 2011, it went to about $2 billion, right? Last year, we did about $4.8 billion. We're targeting about $5 billion. And one of the mix that has changed that conversation is digital termination of remittances directly into mobile wallets and into bank accounts, right? And some of this is as a result of collaborations between banks and fintechs, right? So there's a unique way to reach the unbanked by leveraging on certain levels of technologies of the fintechs and also their nimbleness, which my fellow colleagues have already mentioned. I know Mr. Uwa mentioned something about regulation being a bit tough on banks than the fintechs. Good thing about Ghana is that we have a fintech innovation unit that has the same regulation for banks and fintechs when it comes to financial technology. So there's no difference in that sector. But the good thing also is, Mr. Uwa, fintechs rely on your infrastructure from an operational perspective and the compliance infrastructure and technology infrastructure also. But fintechs are nimble to reach certain spaces that banks cannot reach. So this digital termination of remittances allow people in the hinterlands to access remittances, and previously they couldn't. Even if they could, they had to depend on somebody in Accra or Kumasi to go to a banking hall and answer about 20 questions to get a remittance money and bring it to them, and sometimes they give stories that the money got stolen or all those kind of things. So yes, the future happened yesterday. Fintechs are collaborating. We in ASA, for instance, we operate in 115 countries. And then when we tell our story about some of the challenges we face in different markets, a bit different from what is in Ghana, but almost the same. Where in certain markets at all, there's no something like GIP. You can't settle directly into a bank account, right? It has to go through some approval processes before funds are credited into an account. So I think there's a unique way of fintechs utilizing their resources. In other finance, we have a robust technology. We have an infrastructure that we've leveraged in the 115 countries. The banks have their robust compliance infrastructure that we rely on to make sure that whatever transactions we are doing is avoiding any form of money laundering, right? So there's that level of collaboration from a technology perspective and an operational perspective.
You seem to be focusing on technology driving the game-changing fintech space. What are some of these technologies that are driving those changes? And why have the banks not been able to invest into those technologies? Because if it's about money, the banks have the money. So why are we not seeing the banks investing in those technologies that are making all the changes we are seeing in the fintech ecosystem?
So I'll answer your questions in two folds. In the first fold, primary responsibility or focus of banks have been financial intermediary, right? They were focused on driving deposit loans and a couple of transactions and some level of payments with cards. Now, these fintech technologies, I'm not talking about new technologies like blockchain or AI or Internet of Things, but creating something you call a switch. So for instance, in Ghana, we had a switch to drive card payments or card withdrawals, right? But these fintechs were able to understand the needs and problems of the unbanked. And one of the things were that people wanted to receive payments at their convenience. And how do you do that? You have to create a solution that connects the bank with the last mile transaction, right? So fintechs created something we call APIs and other services that allow you to connect two businesses together. For instance, as a finance, we have an API that can connect 1,001 remittance companies with banks and PSPs in different markets to do last mile termination. And that technology of API is the focus that we focus on. We're not saying banks cannot do that, but the banks do need to invest that money into it. Because remember, when the bank core focus is not driving full payments, they are doing several things. When you build an API, it's not just building the API and it stands on its own. There's a whole conversation around there are people managing it, there's monthly maintenance, there's several costs around it. If you look at the cost-benefit analysis, do you work with a fintech to provide you that API, or you do it yourself? So there are business decisions that allows banks to work with fintechs than doing it by themselves.
Okay, thank you. Now, Mr. Wah, in all this conversation about the changing landscape of financial services, one critical argument or contention has been the need to democratize money in terms of the issuance, the regulation, and the use. And we've seen efforts from both the regulator perspective in terms of digital, central bank digital currency, and the private sector perspective in terms of cryptocurrencies. From where you sit as an association, are we at the point where we have to democratize the issuance, use, and regulation of money?
If Kwame Opon were here, I'm sure he would have been the best person to answer this question. But one core element or functionality of money is strength in terms of what backs it. You understand? And if what has happened in recent times within the cryptocurrency environment is anything to go by, then we should be talking about how do we regulate even more because of the incidents that we've just recorded recently. Last year alone, the top 10 crypto exchanges that filed for bankruptcy lost $21 billion, top 10. You know of FTX, 9 billion, Genesis, 3.4 billion, all the others, 1.3 here, 1.2 billion, 1.1 billion. These are people we don't know. We were just trading instruments online. There's no regulatory body behind, so there's no recourse mechanism for participants. And all you hear is this exchange has filed for bankruptcy. You, the investor, you have no recourse for recovery. So yes, the fiat money in its form as in physical rendition for transacting may change or evolve, or it started evolving already. Over time, we are going to have less of physical money for transactions, and we will deal more within the digital environment. I'm sitting here, I can go a week or 2 weeks or 3 weeks without handling money or visiting my bank branch. But I'll be transacting, I'll be taking taxis, I'll be buying food, I'll be paying bills, and I will not have to see the money. But that money I'm transacting within the digital environment has a backing. I have a deposit sitting at the central bank under the regulation of the central bank. You understand? So there must be a backing for what we use to exchange goods and services. And that is what is lacking within the crypto environment, which provides less recourse and may not necessarily build consumer confidence and trust. Cryptocurrency just about a year or so ago was trading at $68,000 to one. Now it's around $18,000 to $20,000. It's just moving like a curtain in your room. How do you find a balance of if that is where you are storing your wealth? Does it give you the store of value, which is one important element of any kind of money you will have? Does it give you that store of value? I'm not sure it does in the manner that we want to see. So we will see less and less of physical cash, but I'm sure regulation is critical to ensure the sanctity of the environment.
And I'm sure this question and answer is of concern to a lot of people sitting here who think that we should be liberalizing the money issuance market. By way of information, we'll have a Q&A session. So please note your question. When we get to that time, you'll be able to ask them. Thank you. Now to Mr. Duma. According to the Ghana official demand side survey, we've been able to significantly increase financial inclusion in terms of access. That today we are at 95 and 94% for the formal and non-formal channels, achieving more beyond the 85 target that we had by 2023. But when you read that report, you realize that beyond the access, we are not promoting use, retention, and upgrade in terms of encouraging people who have been given the access to stay on the platforms or continue to use the financial tools. What's within the GCB ecosystem, or what initiatives are you rolling out to ensure that people do not just, for instance, sign up to G-Money, but they are using it, and when you provide upgrades in the future, they will be able to continue to use that so that we can retain the population within the financial inclusion bracket?
Yeah, thank you very much. Yeah, it's good. Yeah, thank you very much. Like I said before, GCB through G-Money is seeking to fill a gap in the system. Okay? Through G-Money, I think that if we want to get people not to just assess, but to use products like this, then it must become a habit, it must become part of their daily use, it must be solving a problem. We have used G-Money, for instance, to make payments of LBCs to cocoa farmers. We've used G-Money to do work with Cocoa Board for fertilizer. We've used G-Money for the national, the numeracy, for the national census. Okay? So I think it's all about making sure that these interventions are at the forefront of providing solutions to customers. One of my colleagues here spoke about money transfers and all of that. It's interesting to see how you can terminate on networks, digital networks, such that people who have hooked on through their phones to these networks can get paid without traveling from Akumadine to the nearest GCB branch to be able to go and take their money physically. So it's all about how we integrate our services, okay, and our products into the real sector of the economy and make it useful to people, make it a solution to what people are looking out for. If you cannot provide a solution and you cannot solve a problem, then it's going to be what you try to allude to, a 9-day wonder. They just assess it, but after that, nothing then happens. And I do believe as the economy grows, picks up again, as people get used to digital platforms, as the literacy deepens, banks have a role to play, fintechs have a role to play. We both have to work together. Fintechs cannot survive alone without the banks. Just like banks can't survive alone without there are certain things that we have that they need to leverage on, and we also have to leverage. So cooperation and collaboration is going to be very key, and it is through cooperation and collaborating that we can identify solutions which are cost-effective and long-lasting. So it comes back to the fundamentals. Between ourselves and fintechs, as banks and fintechs, we have to strategize. We really have to strategize. And when we strategize, we have to find ways of the synergies. Where are the synergies? How do we take advantage of those synergies? And finally, it should be something that we can scale up. Okay? All of these things we are talking about, if they are not scalable, then they will run down the rock. So at the end of the day, we should be able to strategize with our ecosystem and all players in that ecosystem. We should be able to synergize, and ultimately we should be able to scale up.
Thank you. Nana Bennett, the unanimous verdict seems to be the need for collaboration between the banks and fintech companies. But do you think that we have a current regulatory regime that allows for that, or there are some changes we need to do to our regulations to allow for closer working relationships between the banks and fintech companies?
Well, I certainly believe that in Ghana we're uniquely placed to see a lot of support in the regulatory space. Kwame's department in Bank of Ghana, Fintech and Innovation, I don't think most central banks have those sorts of things. So that brings the conversation to the table, if you like. They've also created a sandbox environment in the central bank where we could go and test products and services with their involvement and with their collaboration, which ensures that when these products now are ready, approvals, etc., will go faster. So these are things that obviously we don't take for granted. We may not have utilized them as much as we should, but certainly there are opportunities for us to even accelerate where it is we're going further. Areas where I think we need to work with them have already sort of been mentioned. There seems to be a little bit of a time lag when it comes to some of the regulatory approvals and stuff when it comes to traditional banks venturing into this space versus fintech venturing into this space. Part of it is understandable. If you look at the bank system as a whole, it's slightly more complicated than if you look at its fintech person. So for example, for most telco wallets, most customers would only do the KYC Lite, which is your Know Your Customer Lite. The bank has customers who have to do the full KYC because it's slightly more complicated. But if somebody comes in to do KYC Lite, they are accessing your system where other people are doing the full KYC. So the implication of that impact on the system has to be assessed. But be it as it may, we believe that there is still scope for us to work together to try and make sure that these things are done in tandem so that there's not too much of a time lag between both parts. PAPS has just been launched, and the MD of the Ghana Stock Exchange was talking about PAPS. And banks were very, very keenly for chasing GCB on its tails to try and do transactions. But one of the things that is very important for us is to ensure that the regulators and the regulation is also following at speed. Because it's one thing to do the solution and test it to know it's technically working and everything. It's another thing to make sure that when the transactions are coming, you are not falling foul of any policy, and those things have been smoothed. When it comes to PAPS, all the central banks have agreed in theory. But when it comes to the working, we need to just make sure that we are also following closely to make sure that these things sort of work, yes.
Thank you. Now to Miriam, yes, collaboration, everybody is up for it. But what do you think will be some of the things that will hinder any effective collaboration beyond the talk for fintech and banks to collaborate? What are some of the red flags that, for instance, if a fintech company is looking to collaborate with a bank, that company must be ticking those boxes and making sure that those things are in place before coming to a bank, for instance, like Stanbic Bank?
Thank you. So yes, we indeed want to partner the fintechs, but there are key areas we all need to pay attention to. The first one is unforeseen risks. And these are risks around strategy, operations, compliance, cyber. And the last presenter did mention that you can get excited by, rolling out a particular solution, but you get to a point where you realize that there's a breach somewhere. So it's important we pay attention to the risks when we are in partnership. The second one, it's over-reliance on technology. We get to a point where the banks are seen as just a back-end supplier to technology and products, vis-a-vis being in it together with a fintech. And you end up finding a fintech helping the bank to manage customer relationship. When we do find those bottlenecks, it becomes a bit of a challenge for us to proceed with the kind of partnership that we intend to achieve. And I think the last one for me is where we get to a point where we find a fintech talking to a customer without the bank. And this actually affects trust, because you have a bank managing a customer at one point and also bringing a fintech on board to deliver a solution that would address a particular need. So I think it's important that we keep an open mind when we agree to have some of these discussions around partnerships and investments, to ensure that whatever we said we would do, whatever we want to get to, as a team, we would achieve together. I think these are quite important areas.
Thank you very much. And to Alan, at the center of all this innovation and craze is the customer. So are we unnecessarily exposing the customer to risk? And what are some of these risks, and how do we protect the customer?
Yes, as said, we are dealing with a third party that is also a partner. And so in working with them, where we are very much regulated and they very lightly regulated, through our collaboration and through our partnerships, yes, they get exposed to our products. But then in getting exposed to our products, they also get exposed to certain risks that are there. There's a rise in crime today, online crime, or fraud for that matter. We are also exposing them by getting them to use our products and services. It is therefore critical that as banks, we put in the necessary safety barriers that ensures that the relationship between the bank and the customer is always addressed. We must make sure that they must feel secured within the physical space and also on the digital space. We must make sure that we educate them. We must drive financial literacy and education. We must make them aware of the risk imposed. Many a times, yes, they sign on the products and services, the fine print they hardly read. We must encourage them to read so that at least they are fully aware, such that when something does happen, it's not like the bank was negligent, but then they have been informed and they've taken a decision mindful of the risk. It is important also that customers assess their risk appetite. Because depending on your risk appetite, you may decide to go and play in crypto or decide to play safely in FDs. So it's important that they are educated about it. They are thinking through some process that gives them a good understanding of their risk appetite, and the bank can then, through its financial advisory service, provide them with the relevant product and services that addresses their needs. In banking, it's all about relationship, and therefore it is important that that relationship is kept very secure, very intact, free from fraudsters, free from crime, free from any other thing that can damage a relationship. Because once that is damaged, it's a big thing within the industry. One bank goes down, people begin to doubt all the other banks that are there. So it's not just one bank, but all those in the ecosystem must ensure that the safety of the customer is key. Their concerns are addressed, their pain points are addressed, and that would help foster, grow the ecosystem, grow the banking sector, and of course, its implication would be, of course, the profits we make, the income that comes to bank, employment opportunities, further investments in fintechs, investments in customer service relationship, products and services, which at the end of the day, for the good of the customer. Thank you.
Thank you. So before I open the floor for questions from the audience, I want us to do a prophetic exercise. Each of my panelists have 1 minute to predict the future of finance. So we'll start with Mr. Adumako. What will be the future of finance from what we are experiencing today?
The future of finance, like somebody said, maybe to be democratized. I see in the scope of what we are discussing, in the context of what we are discussing, if I have to prophetize, I see people being able to ask for loans, a bit of which is being done today, and get loans through their tablets, their phones, etc. I see people having the ability to manage their wealth on phones. I see even in investment banking space in global markets, distribution of fixed income products, all going down to the mobile phone. So I think that the future for me, I'm very optimistic, despite the challenges we may be having today. I'm very optimistic that technology will disrupt traditional banking significantly, even more than we are currently seeing. Banks will have to work with stakeholders, including fintechs, to come up with solutions that are sustainable and solutions that are profitable. We all talk about collaboration, but it can't just be a talk, okay? Some of us are ahead, some of us are behind. It's always a challenge to allow people to leverage on what you have built already, but in the spirit of collaboration, and if we have to make a bigger cake for everybody to share, then the collaboration must be real collaboration. And so I go back to my earlier statement. We'll have to strategize up, we'll have to synergize up, and we'll all have to scale up. That's the only way forward.
Thank you very much. Mr. Banahini, how does the future look like?
The future looks great. Myself and Asa Finance, we see the future of the African market and Ghana especially. We improve on cross-border payments, right, to drive continental trades. So our ability to do cross-border payment is something that in some few years, hopefully no more than 5 years, this should be an active. I know there's PAPs, but there can always be different payment trails. I know some banks are doing their own payment trails, but there should be that cross-border payment, and Asa is looking forward to collaborate with key partners to do that. Also, the access to certain financial services. We've spoken about financial inclusion a lot, but it's limited to a certain service. Certain financial inclusions are not available to people, and my senior colleague mentioned loans. You know, some people, I know there's some level of soft small loans, but I mean immediate loans for certain small businesses, having the right credit analysis technology available to profile them, having the right payment rails to pay the money in a more faster way. In terms of insurance, in terms of the capital market, I heard her speaking, and I think last time I was speaking to a friend, and he told me the volumes on a daily basis on the capital market, and I personally feel we can do more with collaboration and technology. Also, the future should look at how the diasporans Because as you know, we are traveling a lot. Every day, people are moving to the diaspora, and there's a correlation. People are looking to buy houses. People are looking to pay for pensions for their family members in Ghana. People are looking to save money for their family members in Africa. How are we going to collaborate together to make sure this level of relationship between the diaspora and the African market is happening?
Thank you. Miriam.
Okay, so in terms of the future, digital banking will grow. And if it will grow, it will be focused more on digitizing processes and customer interaction. And to Mr. Ademako's point, we would see a lot of mobile engagement. So mobile is going to be the front of how we interact on our daily basis. Data is one of the things that will drive how we execute in the future. So it's quite important that we invest in how we analyze data within our space to make use of every data that we get exposed to. To ensure that we are part of making this or bringing this to reality, the banks and the fintechs will have to continuously collaborate and make sure that we move away from the us against them mindset and ensure that we carry along driving a growth mindset vis-a-vis a fixed mindset. Thanks.
Thank you very much. Mr. Ewa.
Yeah, thank you. It's been said in the past, particularly within the banking circles, that technology is an enabler of banking operations. In the future, technology is going to be the business of banks. It is what is going to drive value within the banking system. And as I said before, banks in the future, and this future is not going to be a very distant future. Banks in the very near future are going to be gigantic fintechs. So fintech guys, be on standby. The banks are coming. So they are going to be huge fintechs. That's what is going to happen. You can take this box in a couple of years' time. And the next one, which happens to be the last point I'll say on this, is the future of lending is also going to change. Now we talk about collateral. Now there's going to be in the near future a bit of it, which is always already happening. In the very near future, your digital footprint is going to be a better collateral than your property in Kwabena. So a bank will be looking at your presence within the digital arena more than the physical collateral or physical house that you have in order to assess your credit worthiness or your ability to pay back, even for a mortgage or other financial products. So it's bright, the future is bright. There's a lot of work that we have to do together. It's not, as has been said, us against them phenomenon. It's how can we compete or collaborate, by competing and collaborating at the same time. Thank you.
Thank you very much. Alan.
For me, a couple of issues. Competition is going to be even more intense than before. Two, we would see other non-banking players taking up some banking services, as we've seen in other markets. So don't be too surprised if we begin to see ShopRite, which is quite big here, begin to offer some financial inclusion or some financial services to their customers as they also diversify and look for more income in that space. Our customers are going to be more demanding than before, and so the onus will lie on us as businesses or as entities to respond quickly to them, be more innovative. Speed to market would also be key. And then, of course, our regulator and policies that ought to be put in place. The policies are important. They should not lag behind. They should even be proactive to be able to envisage where the future of banking is and begin to guide, monitor, and shape banks and other players within the ecosystem towards that future. They tend to lag a few times, but they have been also proactive in addressing the concerns of banks. This disruption we are currently facing, but of course very necessary, very competitive, would also affect other industries. The insurance market will be impacted on, the stocks market will be impacted on, the investments firms would also have their fair share of working with fintechs going into the future. And we must brace ourselves for it. We cannot stop the growth, and so we must come along, innovate along to stay relevant in the future. Other than that, we will die.
And finally, Nana Bene.
Thank you, Richard. I cannot ask for offertory for this prophecy. and the reason why I can't do that is because it's with us. This piece of glass that we all own dominates most of our waking hours today. What was the first thing you looked at when you woke up?
Your phone.
And while we've been talking, you've looked at it about 2 or 3 times. Combine that with AI and data. This phone can predict where you live. Because today, if you go onto the phone, it will tell you where you were at 12 midnight, and it can tell you where you were at 12 midnight every single day for the last 1 month. So, with that as our construct, there's a lot that can be done in the digital world to predict your needs and to direct products and services in ways that we cannot even imagine. So given that sort of level of where we are now, it's just set to explode and increasingly dominate more and more of our financial services. So we ignore the fintech innovation, we ignore it at our own peril. I think for me, the next immediate future is to answer the question for most of the consumers: where can I redeem my money on my phone, or where can I use my money on my phone? And you talked about the 9-day wonder. Everybody is using it, but in terms of using it for transactions and merchants, we are still not fully there yet. And I believe that in order that this doesn't become a 9-day wonder, that aspect has to be resolved, so that I don't have to go and look for the 240,000 agents to get cash, but I can actually go there and just use the phone to do it. Once that is done, this world as we see it will explode. And that's why ourselves at UMB, for example, are so focused on the SME when it comes to this whole fintech development, because we believe that is the next frontier which will now explode this thing completely.
Mr. Wa wants to top up his future prediction. Maybe because Mr. Nana Bene said we're not going to do offertory, so he wants to generously add. Mr. Wa, over to you.
I want to top up my wallet.
Yes.
Okay. I also believe that in the future, there will be nothing called mobile money agents, because there will be less of transaction truncation needs. Transaction and the supply of money, or the velocity seamlessly to be paying for this hotel bill, the hotel be paying the utility. So there will not be a point where you will need to cash out. Because when the money hits your account, you transact using the same mechanism to improve on the velocity of money. So it is that future that we should all anticipate, where we will not at any point be looking for where can I go and withdraw that money. Because when we withdraw the money, what do we do to it? We use it to transact. But there will be avenues for those transactions to happen within the digital arena.
I think this panel deserves a round of applause. We can do better. We can do better. I think before we open the floor for questions, I want to express my gratitude to the panel for sharing their insights with us and for gracing this occasion. We thank you so much. Maybe now we open the floor for how many questions? We have 10 minutes. So maybe we can do 5 questions in 10 minutes. So let's see by hand those who have questions. And then if we can pass on the mics. Okay, there are mics around. If they can just stand by the mics. There are mics placed at very vantage places. And then please identify yourself and ask your question. You can direct it to any of the panel members or ask a general question.
Good morning, Richard, and congratulations, panel members. You really tackled the topic. Mine is more of a puzzle, and it has to do with some work that we did about, I'll say this 2 years ago. The telcos have proved to us that with the advent of telcos lending, you can actually disburse 100,000 loans in a day. So I took it upon myself, based on my schedule, to find out what exactly are the banks giving their customers in terms of their banking app. And I sampled about 20 banks. And to my surprise, only 2 banks were doing direct lending within 2 minutes to their customers. So about the rest of all the banks, the app was just for movement of cash and nothing in terms of lending. So I'm asking myself, the virtual world, which is where every customer wants to interact with as a bank, and knowing the fintech world that the technology exists, why are we slow to that adoption? In other words, that part of the solution, why are we so slow to admitting the fact that that is what the customers want and that's how they want to experience us?
I think I'll leave it to any of the panelists who want to respond to it.
Yeah, let me attempt a response. You know, as a country, sometimes our regulations and laws also inhibit our pace to accelerated growth in these areas. Why do I say this? The telcos are doing that aggressive, and they are able to do it quickly because they've harvested data that we provide to them, and through some algorithm within the data set, they are able to tell how much to give to Mr. A or Mr. B or Mr. C. To what extent is regulation facilitating sharing of this data to enable banks plug in and also use this data, which is readily available, is our data, to be able to use it to also quickly, move to that step? How do I lend to someone who has 200 Ghana cedis on the bank account and wants 3,000 Ghana cedi loan in 5 minutes? How do I do that? But with your digital footprint alone, even if you have nothing on your bank account, I know what you are capable of transacting, and through that, I can quicken and hasten my pace or the bank's pace towards delivery of this. And all this can be driven through regulation. Someone talked about open banking, where we share APIs to enable third parties plug into this data set and use it for safely, and I emphasize safe use, and use it to generate and broaden financial inclusion. So it's not like banks do not want to do it, but the avenues and the data availability is more or less not shared. We don't know where that data is sitting. I have my data sitting there. I cannot use my bank to access financial products using my own digital data, but it's sitting somewhere. The amount the telco can give me is limited because of capacity. But the bank too cannot help me unless I go and maybe have a salary and my employer guarantees and stuff like that. We are moving, but regulation must move in tandem. And I said our laws inhibit us in ways because we have passed the Data Protection Act, which is the best part of British data protection, the best part of Canada's data protection, the best part of USA's data protection, and we are put all into one document called Ghana Data Protection Act, which is stopping us from doing a whole lot of things. You understand, these countries shared data long before they introduced data protection to protect this data. Now, before we can share the data, we are protecting it. So where is it? So we need to move to an arena where there is safe use of data, and that data is available to all players within that ecosystem safely. We have regulatory bodies, the Cybersecurity Authority is there, Bank of Ghana is there, we have FinTech Office, we have the regulatory bodies in other areas of money creators within the ecosystem, and regulation can drive this, and we can have safe use and, deepen financial intermediation through, all platforms, and also thereby improve our pace to financial inclusion? It's a very important question, but I think regulation must drive that.
Thank you very much, Mr. Iwa.
Just to add to what John has said, yes, in the micro lending space, we may not be there directly, but indirectly, we are supporting those who are doing micro lending with financing. And therefore, whilst you may have visited 20 banks who are not, when you go into the micro lending space, it is far much more lesser than that. A lot more banks are providing funding to support the micro lending. They lend as low as 30 cedis, as much as 3,000 cedis. Now, if I was, as a bank, to lend to someone 30 cedis, what tenor will I use? What monitoring would I use? So the digital footprints, their expenditures, how they spend it, gives them a better understanding of the customer to be able to lend them 30 cedis. Can a bank, with its size, looking at the resources, invest in monitoring a 30 cedis loan? But of course, little drops of ocean make a mighty, little drops of water make a mighty ocean. So you can imagine, if my 30 cedis that I'm given at the bank level, 100,000 of it or more goes down the drain, obviously that is big. But I don't have the tools, I don't have the means. I'm more specialized towards a certain level of lending, unlike the telcos that are using data and can track and monitor. For us, for those who are using the phones, obviously it's a way of life, as Nana Bene said. The telephone has become a way of life. You take the telephone away, they have no life. They don't have data, there is no life. If they cannot communicate, there is no life. So the data, airtime has become the life upon which you now can have relevant information about the customer, and for which you'll be able to use that data to say, I will lend to you, I will not lend to you, based on your spending habits, among others, which the bank can't afford to do. It's not a space worthwhile to do, but they will support telcos in that direction to lend out to as many customers that qualify, using that algorithm to determine who must have money and how much you should pay per tenor, per interest rates, among others. Thank you.
Thank you very much. You have a question?
Yes,
please go ahead.
Yeah, my name is Fred Amese. One of the early innovations in the fintech space is eSwitch. Unfortunately, it sort of collapsed. My question is, what was responsible for the failure of eSwitch, and whether or not there are some lessons that have been picked from the failure of eSwitch? Thank you.
I think, Mr. Wa, you will be the right person to answer this question.
Yeah. So I remember during the launch of eSwitch, somewhere, I think 2007, 2008, I used to work in one of the banks, and we took a very aggressive view of customer uptake. So we went and bought over almost 2 million to 3 million base stock of the eSwitch cards. Unfortunately, that became more or less a loss to the bank that we had to write off. You see, technology is tricky. If it must serve a need that does not either exist, or a market that does not exist, or is driven by customer demand. So eSwitch more or less was to compete with our traditional cards system. Was it going to do anything different from what maybe a MasterCard, a Visa card, or the other bank proprietary cards was doing? I stand to be corrected, but I would say at this stage, perhaps no. And how it was also rolled out, it was rolled out not from within the banking system. It was more or less driven from GIPS, and more, GIPS is seen as a platform provider, and eSwitch is a customer or a consumer product. and platform providers selling the consumer product through which networks. So there were a lot of perhaps missteps on the rollout. It's a very fantastic product. It is still in existence, by the way. National service personnel are being paid through eSwitch. I think the population census, they also paid some of the coordinators via eSwitch. It's still functional, but here I also announced that there is a new boy in town called the Ghana Pay, which is the banking industry's response to eSwitch and the other telcos' mobile wallet. It is more or less an alternative to what eSwitch is doing, and potentially over the course of time, we anticipate that it's going to weed out eSwitch and replace it, because it's a product that is also being worked on with KIPS and our friends here, all the banks, our partners on that platform. So yes, a product is as good as how it is rolled out, and I'm sure there were some missteps on the eSwitch rollout.
If I can just add very quickly to it, I mean, it's a perfect case study, if you like, for the evolution of innovation. I think when eSwitch was launched, it was launched as a closed system. And what do I mean by a closed system? The cards were proprietary, and you had to use its own ATMs to be able to use it. So if you were in an area where the eSwitch ATM was not there, you couldn't sort of use anything. So that's part of the problem, was that address the customer need. In time, it's been upgraded to GH Link. So it gives us a new card, which is a GH Link, which allowed you to use on all ATMs and made it even better. And as John is saying, in time, we've upgraded now to Ghana Pay, which is now like a wallet, which ensures that the usage is even wider. So the way in which innovation grows, sometimes it starts from a very small closed loop until then it sort of grows wings. So that's a lesson about stocking too much on any technology as it keeps changing. Thank you.
Thank you. Do we have more questions? Yes, please go ahead.
Good morning. My name is Aurangzeb. I work in Asha Savings and Loans. I'm the CEO over there. In my opinion, maybe I missed the point here. You see, a lot of discussion we did on fintech collaboration, challenge, competitions with financial industries. But are we missing a point here about the customer education, customer awareness? My question here to Mr. Wa mainly, who is investing more in customer awareness? Is the financial industry, bank, or telco, or fintech? Who is investing more in the awareness making or educations? In our company, we did a small research on customer awareness on digital platform, and see if we did some small research in Dansuman, Odokor, then going down to Malam, Oiza, Amanpur, Kasua. So we have seen a big difference with this area when we go to Soidro, Mankasim, Salpond, like this. So are we investing proper time and money for customer awareness or not?
Sorry, to clarify your question, I'm suspecting that by customer awareness, you mean financial literacy.
Yeah, financial literacy, their interest to register in digital platform.
Okay.
Mainly so, like this.
Mr. Wa, over to you.
Yeah. Thank you very much. It's a very important question. I don't have the answer as to who is investing more in financial awareness or financial literacy. As banks, individual banks have internal programs on financial customer outreach programs. Even at the association, we are collaborating with the Financial Literacy Center. And just recent, I think last month, the whole of last month was dedicated to Financial Literacy Month, where we did some level of outreach. Is it enough? No. What I would say is, given that we are all more or less focusing on that customer. And that customer is multi-banked, multi-platform user, and it's all over the place. It should not be telcos doing it, fintechs doing it, and banks doing it. How do we work together to improve customer education? It could be all players coming together, having a fund of a sort to deepen, because customer education is one tricky area. If you're not careful, you confuse the customer. If MTN goes and does some level of customer education talking about A, B, and C, then a bank goes, we have 23 commercial banks, this bank goes and says that, another bank goes, but there is a thematic education that the customer needs, which can be driven from the center or from one angle where it focuses on the core needs of the customer, the products that are coming, how to safely use these products. And I'd like to emphasize safe of use, because the problems we are having within the ecosystem now, if we do not tackle them now, may be our own nemesis going forward. It will be the issues that will stop us from moving forward. If I lose money on a platform, I'm not sure I'm going back to that platform anytime soon. And that is one customer lost and one too many. So we need, as players within the ecosystem, as banks, we come together, even we are planning on customer education drive on social engineering fraud, which is one key fraud which is hitting all of us here, from fintechs to banks to other players within the ecosystem, social engineering fraud, where they use our own presence within our own social settings to defraud us. So we are planning on a campaign. But to answer that question, I think we need more concerted effort. A national agenda driven even from the policymakers to deepen financial inclusion through educating people on safe use of financial products. And when we say safe use of financial products, you can be a professor and be financially illiterate. So it's not as whether you are educated or not educated. It is how, to what extent do you understand the products that are exposed to you or you expose yourselves to. So that is the kind of thing that as players we should be doing.
Sorry, I just want to add just two quick things. One is I started using Momo maybe about 10 years ago because my uncle in the village told me to send him money by Momo. That's how I started to use Momo. And later, my Baba wanted me to pay him by Momo, and the driver wanted me to give him Momo. So they taught me how to use Momo. I think that if we were to educate, we should focus a lot on the benefits of the technology. Because I think that regardless of people's level of education, once they know the benefits for them, the education follows almost seamlessly.
I think I give the last opportunity to the lady by the mic. We are hard pressed on time, so the lady by the mic. So sorry.
Okay, so my question is to the banks, and then I'll just want Nana to answer this. So we all have platforms. Let's say the banks all have platforms for transactions and for payments. I want to know how are these platforms going to help SMEs as opposed to Momo?
Thank you very much. One of the things that we've struggled with, especially with the SMEs, is when cards came, the infrastructure for merchants to accept payments on cards was very expensive. So most of the business people did not really want to use it because the cost was far outweighing the benefit. Now, as a result of technology, we can offer these merchants and business people a way to receive payments that is not so costly. And so that's where we are now working, so that, because the benefits are many, if you are receiving online payments, you don't have to worry about cash security and storing cash, etc. You have better reconciliation in your systems. And if you sell things on Instagram, etc., you can see your real-time payments and everything coming in. But the obstacle, the barriers of entry, was the cost. Now with the technology, that cost has come down. And then with the collaboration with the fintechs, they are coming up with even more and more innovative payment systems that allow merchants to actively participate in this as well. So that's how certainly we at UMB are trying to drive the agenda to the SME.
So on that note, we say a big thank you to our panelists and a big thank you to all of you for listening to us. Maybe we'll do a group picture for the memories.
And while they prepare for the group picture, I would like to say a very big thank you to our sponsors, Stanbic Bank, Asa Finance, FBN Bank, Glyco, GCB Bank PLC, and to our media partners, Global Media Alliance, City FM, City TV, TV3, Onya FM, Asasi Radio, and Happy FM. You can also follow the conversation on Twitter with the hashtag #TheMoneySummit2023. And don't forget to follow us on all our social media platforms, the BFT Ghana, and on LinkedIn and YouTube, we are the Business and Financial Times. All right, thank you very much. From here, we will zoom straight into a very quick coffee break. It's going to last for 20 minutes, and after that, we'll come here for the second plenary session. Thank you very much. Financial Times app. Just go to your Google Play Store, download the app from there, and then you can automatically be receiving our exclusive news items on our app. You can visit Play Store, download the Business and Financial Times app, and then receive exclusive news items from us. Also follow us on our social media pages on Facebook, Instagram, Twitter. We are BFT Ghana, and on LinkedIn and YouTube, we are the Business and Financial Times. If there's anything we've learned so far especially from the first plenary session, it's about innovation. Innovate or die. Join the digital train or find yourself out of business. Now, the second plenary session is also going to be an engaging one, and the topic under discussion for that is going to be Africa's robust securities industry, the role of insurance, pensions, fund managers, and other market players. So I'm going to be inviting the panelists to join us up here. So the first person here is Mr. Edward Foko-Che. He is the Group CEO of Glyco Group. Please let's give him a round of applause as he joins me up here. Mr. Edward Foko-Che. And then we have Miss Eugenia Bashe. She is the Managing Director of Tessa Capital Limited. Miss Eugenia, Managing Director of Tessa Capital Limited. And then we have Mr. Kobna Buama. He is the Managing Director for Stanbic Investment Management Services. Please join me up here. And then we have Nana Riafi Buama. He is the Chief Investment Officer for Axis Pensions Trust. And then Miss Jifa Fiati. She is the Head Group Business Star Life Assurance. Okay, so while we wait for our panelists to come from the holding room, I'd like to quickly acknowledge our sponsors and partners for this event: Stanbic Bank, Aza Finance, FBN Bank, Glyco, GCB Bank PLC. Thank you so much. We are grateful. And then Global Media Alliance, City FM, City TV, TV3, Onia FM, Asasi Radio, and Happy FM are our media partners. There's a short video of the process of downloading our app on Play Store. And if you are on iOS, just give us a few weeks. We will be there very soon, and then you can join the train of downloading our BFT app and then subscribing to the digital version of the newspaper. Also, if you want the hard copy of the newspaper, just see any of the staff around or the protocol team, and then they can enlist you on our subscribers list so that you can always receive even the hard copy of the newspaper as early as 4 a.m. in the morning. So our panelists are joining us at this moment. Please let's give them a round of applause. Thank you so much for taking time off to join us for this discussion. So as I stated earlier, our second plenary session is going to be on the topic Africa's robust securities industry, the role of insurance, pensions, fund managers, and other market players. And now that we have our panelists in here, I would like to mention them for them to fill the seats over here, and then our moderator Alfred Okanse will join us. So Mr. Edward Foko-Che, he is the Group CEO of Glyco Group. Please let's give him a round of applause. Miss Eugenia Bashe, she is the Managing Director of Tessa Capital Limited. Mr. Kwabna Boama, he is the Managing Director, Stanbic Investment Management Services. And then we have Nana Riafi Boama, he is the Chief Investment Officer for Axis Pensions Trust. And then we have Miss Jifa Fiati, she is the Head Group Business, Star Life Assurance. And to the man to drive this conversation to a successful and fruitful end, we have our moderator, Alfred Okanse, who will be joining us up here to moderate the second plenary session. Thank you very much.
Thank you very much, and good afternoon. Great. So I think it would just be appropriate for us to put our hands together for the panel members. Thank you very much. To start with, we ended the first session, the conversation about fintechs, and there was the mention about how the various sectors are also going to be impacted by the disruption that fintechs are going to obviously, or are bringing, or have brought already. And the insurance sector, the pensions would also have their fair share of this disruption that we're seeing. So let me start off with you, that's Edward. For you, the insurance sector, and they're going to run through all of you as well, how are you leveraging on the fintech space for what's happening now and what is yet to happen for the insurance sector specifically? Yes.
Thank you so much. Good afternoon, and let me commend BFNFT for putting this together. We'll be looking forward to more of such opportunities to share ideas and to be able to address issues. Back to the question. I'm wondering whether we want to see it as disruption rather than adding to our businesses. You see, from where we sit, we're delivering a service. In the insurance sector, in the pension sector, wherever you find yourself, you're delivering a service. And you're always looking for efficiency. And all we know is that even though technology comes with its own challenges, nobody can do away the fact that technology brings in so much efficiency. So if it has to do with efficiency, then I would say it is not disruptive per se. But then, in our space, what are we doing with it? At least, to begin with, as premium collectors, as insurance companies, as entities that rope in income that comes in trickles, you definitely need such arrangement to support you in doing so. And this is one of the spaces that I believe fintech has come to fill. You're also looking at payment of claims. Some claims may not be that significant, but whether it is significant or not in terms of quantum, it is important that it touches on credibility of our companies. And to be able to do so efficiently, it is important that we use some of these things. So yes, technology, fintech, as we're talking about, coming to disrupt, in quote, the system, I want to see it as something positive coming to us. And the fact that we can leverage on it to improve on our efficiency and also to get more, to be able to reach out to more. Insurance, as we know, is one area that penetration is low. And I believe that this is an area that we can use in enhancing on the penetration. So this is brief that I want to share.
Great point. I mean, the issue of penetration will come to that as we go on. Eugenia, for you as well, in the capital market space as well, and how and this is going to be a brief one, leveraging on technology, fintechs, as more of a complementary intervention and less of disruption. Yes.
Exactly, thank you. As he rightfully said, I think it's more of a positive disruption. And for us, apart from efficiency, we're looking at the customer. How can we deliver better quality services to the customer? Making use of fintech, making use of technology. So right through the customer journey, right from onboarding, right from investment decisions, right from to reporting. How easy is it for the customer to access financial services, to access investments using technology? And that has been our focus the past few years, to be able to deliver the same services to customers, to investors, without them having to walk into any physical office, but being able to do this electronically. Thank you.
Thank you. Alan, I see some telcos also now having some sort of collaboration with fintechs in the insurance space, for instance, where when you buy airtime, some amount that is if you subscribe to it. It's also used as some insurance for you as well. But for the banking space, maybe just briefly, Alan, on the collaboration that you're having with fintechs, especially to leverage on the opportunities that we currently prevail here and what is going to be happening in the future.
Thank you. So we see this as a collaboration, and it's a platform that enables scale. It's very difficult to scale if you're still going through the same mundane onboarding of customers and getting all of the customer information. But the fintech space provides the ability to onboard faster, validate the client faster, and also enables the client to be satisfied in consuming the services that you provide. So it's more of a platform to enable rather than a disruption for us.
Well, Nana, on the same point as well, and for the pension sector as well, there's collaboration.
All right, so I agree with Kwabena and Eugenia's submission. To add to what they said, as long-term provider of finance, we can also collaborate, by providing or financing some of these, fintechs, to grow, further within the constraints of our investment guideline. So that is how, we see how we can collaborate, giving them the necessary, push to grow and expand faster. Thank you.
I see, Jiva, there's a quick one on this as well.
I totally agree with what everyone has shared. In insurance specifically, we have relied on using the traditional means of distribution, using agents and brokers. But we realize that in Ghana, we haven't had so much mileage with this process. Our insurance penetration is still below 2%, whereas in some other markets in Africa, it's about 17% to GDP. So we realize that we have a lot of untapped market. That's a lot that we need to do. And so we welcome fintechs on board to help us in reducing costs and to also be able to meet the demands or the needs of our customers. That's a lot of people we need to insure. And so we welcome them as enablers for our business.
And our conversation is on Africa's robust securities industry, the role of insurance, pensions, fund managers, and other market players. So let me stay a bit further with you, Jifai, for a good reason. Because over time, at least for the past 6 months, all the sectors within the financial space have had their own fair share of the impact of the domestic debt exchange program that we've been on. How is the insurance sector doing? From this Star Life perspective.
All right, we woke up last year with the news of DDEP as an industry. It has been very challenging and tough for us as a business because in insurance, we are actually promising people that we will be there for you. When the unforeseen event happens, you can always come to us and rely on us. So we are keeping people's money in trust. That should the negative events happen to them, they would actually come to us and we'll bail them out. With that said, DDEP has impacted us greatly as an industry in terms of our cash flows. We have made solid investments backed by regulation. We've been guided where to put our monies over the years with the hope that should the events happen, we'll be liquid enough to fulfill our promises. But this DDEP on our cash flows, it's a problem. That said, as an industry, we don't charge the right premiums. And so we are often making underwriting losses. And so investment has been a way for us to show our income, you know, to be able to take care of our customers. And so we are in a deep place right now as an industry. That said, on a company level, individually, companies have different ways they've been impacted based on your investment mix. And so I can confidently say that we at Star Life, yes, though we have also been hit, we've been able to diversify a bit. And we are hoping that when the losses arise, we would be in a good position to take care of all our customers. One other group that has suffered, whom we are not paying so much attention to, are our shareholders. Our shareholders would have to take a hit, you know, with this DDEP, and I believe that when times are better, we should remember to reward them in whichever way or incentives that are available.
I'm sure some of the shareholders are here. I was hoping what kind of reward you're going to propose they should be giving, because obviously, I think that's another group of persons who have not been considered in this entire conversation. Because as of September 2022, when I checked the records, at least with what the IMF made available to us during the spring meetings that just ended, we have commercial banks holding, as at the time, some 59.86 billion of the domestic debt. There's part of it which has been restructured. And then you have the foreign investors, 16.33 billion. Pension funds, and now this is why I come to you. Pension funds, even though we're exempted, 10.88 billion. As we speak, we have the pension bondholders, they are picketing in front of the finance ministry's premises because some 19, that is coupons unmatured, have not been paid, and some principals as well. So how are you within that pension space navigating all of this, the impact of the domestic debt exchange program as we speak?
Thank you, Alfred. So, I mean, firstly, the DDEP didn't come as a surprise to us.
It didn't come as a surprise?
Yeah, I mean, seeing the trajectory of government borrowing, if we thought, I mean, something like that wasn't going to happen, and I guess we're living in Alice in Wonderland. So it was bound, I mean, to happen. Fortunately for us, and all of us who are probably pension contributors, the government exempted us. However, I mean, what we've observed is that government hasn't committed to paying the obligation that falls due on the old bond. And once you hold government bond and you are not receiving your coupon timeously, principal are not being paid, then you will be confronted with liquidity challenge. On the tier 2, side, we are probably fine, but I know some of the industry players are grappling with liquidity challenges on the tier 3 side. The only way we can get around that really is moral suasion, right? If you are due to withdraw from your level, from your tier 3 fund, we plead with you, to hold on. And let's see if government, will start paying and then you can come for your money. So that is how we've been impacted. government exempted us. However, they are not committed, to paying the obligations that fall due on the old bonds. So that's how, I see.
So even though you've been exempted, you are still not spared of the headache. You are still there.
Absolutely. And also, when they delay in paying, coupon, right, we don't receive that accrued income on the delay out. And that is really, losses, to our members. So
I see, but how is that moral suasion that you're doing working? So my investment matures, I'm coming to take my money. Then you say, oh, please wait. I'm begging you, hold on. How's that working?
Well, I think it is facing, the truth. Really, historically, we have honored, obligations, from coupon payment and new contribution. And the coupon payment bit, formed, a bulk of our liquidity available for paying out beneficiaries. So if that portion, which is significant, is not coming through, and you need, your money, what we can do is to plead with you, right? Is to plead with you, exercise patience, and hopefully when government, pays, we pay you back. So really, it is what it is. I guess, pension, trustees would have to be upfront and communicate, the reality to their client so that expectations, are set right from the beginning. Because we are not getting those payments coming through. And once those payments are not coming through, we can't honor as many obligations, that fall due. Coincidentally, this DDEP coincided with the 10th anniversary of the Tier 3 scheme, which allows for members to withdraw without paying any tax. So we've seen quite a huge request for withdrawal because most of the pension schemes available just 10-10. So you just have to, manage around, that situation. What we, did, for where I work, if you've done your 10 years and you qualify for your payment, we can satisfy that obligation without sweat. However, if you've contributed 2 years, 3 years, and you insist that you want your money, then we'll apply the haircut, our colleagues at the fund manager side. Exactly.
So you do your own mark-to-market valuation.
Absolutely. And then pay you.
And you pay you.
Yeah, because the assumption is we are going to sell securities, right? To pay you. So if you haven't, waited for that 10th year and you want your withdrawal, firstly, you've taken us by surprise.
Oh, but it's time for me to take my money. So what is the surprise?
The surprise is, you haven't chalked, the 10th anniversary. And like I mentioned, we have to manage the liquidity situation. If everybody runs to withdraw, we'll be, exposed. So this is one of the measures, we put in place just to, stay, the hands.
I see. But when you explain to the customers, they understand, they're able to then keep their money.
We communicated, early on. We had, various engagements, and I guess, our clients understand the situation we are all in.
Anyway,
because really, if they also held, government bond, and they wanted those bonds before maturity, they may have to go out and sell. And currently, you would sell at 40-50%, discount, depending on your maturity. So.
Great. Alan, so 2 weeks ago, I was talking to Mr. Wa about the decision that the commercial banks took, for instance, to support this whole domestic debt exchange program. The understanding is that you look at the bigger picture in saving the economy. But the evidence of that decision we are seeing in your end-of-year statements that currently is in the public domain, which by law you're required to publish. The losses that a number of the banks are posting as a result of partly because of the domestic debt exchange program, we cannot run away from. But how is the commercial bank space also navigating the impact that we're seeing from the domestic debt exchange program, which is not going to get away from you anytime soon?
When it comes to the commercial banks, like you rightly said, they have taken provisions on the back of these bonds that they held. And these are book provisions. And these provisions should unwind as we recover from this economic crisis. The key issue is, are the banks liquid enough to meet their obligations currently? And I believe the banks are. And they also have the support of the central bank in terms of liquidity support if the need be. So with respect to the commercial banks, I think the key issue is ensuring that they stay focused on what you're doing and ensure that at any point in time, they're able to meet their obligations in terms of customer deposits, and then so in terms of making sure that once the economy recovers, these book provisions that were booked are unwound to make them more profitable. And I think the banks that have published recently, you will see that their Q1 performance actually shows profits.
Indeed.
Yes. So I think it's a positive indication, and the trust that the economy will bounce back should give us confidence as we move forward.
So I'm also thinking about, for instance, now that the private sector is being charged with the responsibility of leading the path out of this crisis, the economic crisis that we find ourselves in. And you, the banks, are one of the major support mechanisms for the private sector in terms of advancing loans and so on. I speak to these private sector players. They are concerned that the banks are not advancing loans to them. Some of you have decided to hold on to some of these loan applications, obviously because of the difficulties that you're faced with right now. So how are you going to convince these people that, you know what, I cannot support your plans or your businesses, but then again, I'm looking at how the economy is going to bounce back as we speak. I just want us to understand that commitment, that conviction that you have as against the private sector now being given the responsibility to lead the process of recovery.
I think one of the positives when it comes to these economic crises that we've gone through is for us to be able to reset the economy as far as interest rates are concerned. I mean, as a country, it's nearly impossible for us to see the private sector grow, expand, when they are borrowing upwards of 30%. It's not possible. Was it in March, we saw treasury bill rates drop, and people were asking questions. Why should the rates drop when inflation is above 45%? The real truth is that we can't have treasury bills hedge investors over inflation. That's a misnomer in the economy, and that has to be fixed. If you want to beat inflation, you should be investing in long-term investments, not buying treasury bills and doing fixed deposits. So if we're able to reset interest rates as an economy, we will be able to fund the private sector, and the private sectors will not be set to fail because they are not borrowing at 30%. They are borrowing at rates that they can't pay because our economy is growing at those levels. So I believe that's one thing we need to pick up from this crisis and ensure that our policymakers are going in that trajectory to support the private sector.
I see. I'm seeing the interest rates on treasury bills actually started rising again over the last couple of weeks. So that's another concern that unfortunately you have to deal with. But Eugenia, so for you as well in the capital market space, how did this DDUP impact you and how you are leveraging as well on the possibilities of this economy bouncing back with the current situation that we have?
First of all, I think for us in the investment space, remember that we have just come out of first financial sector cleanup, where the reality is that the treatment we were given in the investment space was a bit different from what the banks received. And so we already had to suffer those shocks, where some of our clients still have their funds locked up. So that was the first thing. We were just about recovering. Then we had a regulatory directive which instructed a mark-to-market valuation of our portfolios. that caused disruption in our space. We were in the midst of that, trying to educate people, because really mark to market is not wrong, it's not a bad thing, it is a reality. When you have an investment, at each point in time, what is the value of that investment? If you are cashing out, it is the value at the time you are cashing out. That is what you should get. So mark to market is not a bad thing. So we're adjusting to it, okay? We're trying to educate investors as to why mark to market was necessary. Then we woke up and it was DDEP. So for us, it's been
one nightmare
after the other. And we are trying to adjust. There have been promises, for example, we are still waiting for the liquidity support, the liquidity fund.
The 15 billion CDs?
Exactly.
It
hasn't happened yet.
Okay.
So we are grappling with all the issues. Our investors need their money, and we have to deal with that. There are positives. Yes, I think the private sector leading the change. It's not a cliche. There are positives, definitely supported by the macros. But this is the time where, as intermediaries, we need to start thinking outside the box. The pension trustees, Nana and Co, will tell you, we were running to them and making them run to our regulator, MPRA, to say, let us breach the regulatory limits and put more money in government paper. Those days are over. We need to be able to demonstrate our worth as investment bankers. This is when we need to think. We can no longer run to government paper. We told our clients government paper is safe, but we are learning differently, okay? It still comes with risk. So this is a time where we need to be innovative. And that is where I think that the private sector and us as intermediaries in the space should start thinking of how can we take that fintech to market? Who is the next Bill Gates? I think the earlier panel spoke about when it comes to technology and the brains we have in our part of the world. There are a lot of young people who are doing great things in the fintech space. Who is funding them? Who is going to set up a fund to be able to help them to grow these small businesses to one day become the big apples of the world that we've seen in other markets? We need to lead that change. So yes, it's been a struggle, but I think there are opportunities we need to look at as market players. Thank you.
I see. Now, I stay with you a bit because you talked about the mark-to-market and the reason for that. I mean, no financial institution can survive a run on it. So that there was that basic understanding. But that mark-to-market valuation was occasioned by the current happenings in the economy. It wasn't something that existed until now. Okay. So how did you, or are you still getting, and I say are you still getting because I speak to people who still don't appreciate why you should be, I mean, I've put my money in your portfolio. I'm expecting 10,000 CDs. And then I'm coming for the money and you tell me, okay, I'm using a different valuation, so I'll get 6,000 CDs. How do you get me to appreciate that loss as against the necessary decisions that you have to take?
It's been tough. Because when it comes to money, I mean, it's people's livelihoods. So yes, we give all the explanations, all the education, and you finish and the person says, yeah, but I want my money. And that's the reality. We got to this point because we were in an economy where, or in a market where if there wasn't an active secondary market of fixed income securities. So typically, you invest in a fixed income security and you're holding it to maturity, and then you just take your final principal payment. And that is what you return to investors. Now there's an active secondary market. It was okay for the same investors when the secondary market was such that when you go to sell, because interest rates were stable, you actually sometimes make a profit if you have to get out before maturity. But we started feeling the impact of what was happening in the broader economy because the financial markets do not exist in isolation. Yeah. What happens in the economy impacts the financial market. So then we started seeing the impact of high inflation the impact of increase in interest rates, the interest rates on the government instruments kept going up. And once that is happening, there's an inverse relationship between the price of a bond and interest rates. So now I go to the same market because Kwabena wants to make a withdrawal. Remember that I have invested the money. It's not sitting. He wants to make a withdrawal. I have to go to the market and sell instruments to be able to pay him. Now that market at that point to sell that security is only able to purchase that security for me at a lower price than I originally bought it. Who is going to bear that loss? So that has to be priced into the value of the fund. So that is what brought about the mark-to-market. Because if you keep paying those who are exiting, as if we are isolated from what is happening on the ground, what will happen is those who will be left in the fund, who will stay faithful to their investment goals. By the time they are ready to exit, you find that they would have a smaller value. So mark-to-market was important. We needed to be able to pay people at the right value. Unfortunately, it came at a point where interest rates had risen so sharply that the effect was that you see people losing 20, 30, sometimes 40% of the value of their portfolio. It's a hard pill to swallow. So what we tell investors is, don't withdraw because you are panicking. Don't withdraw because other people are withdrawing. If you don't need it, leave it. The market will recover. A couple of weeks ago, we started seeing interest rates on government papers, which most of these collective investment schemes are invested in. We started seeing them dropping, okay? And so once the macros become better, the interest rates will correct and your investment values would increase again. So it's education, education, education. I think that's all we need.
Great point. Thank you so much. Edward, so, I mean, for you as well in the insurance space, I think you heard about what, 1.7 billion thereabout in government securities. And so the DDEP obviously impacted you. But what is the current state of affairs now with respect to the impact that this domestic debt exchange program had on the sector?
Thank you so much. So far as the impact is concerned, I think it has been discussed all over. Discussions are still ongoing. What in times like this we need to realize or do is rather to remain focused, appreciating the fact that these are some challenges that comes as part of business challenges. And therefore asking ourselves, based on our mandate, based on our core mandate, what are we supposed to do in ensuring that we get out of this, in ensuring that we're able to perform better, to build the industry for the future. And that is what our concentration has been all this while, talking about the role we play as insurers in the financial market, the total financial market. What are we doing? Are we coming out of products that will cushion the patrons of our products? Are we coming out of better ways of investment that obviously will not put us into similar challenges in the future? These are some things that we should be doing as industry players, appreciating the fact that let's not stay away from our core business. Let's not stay away from what is expected of us, but take this space as something that has come up, but we need to think outside the box in getting some of these things done. And I believe that is what we are all doing, as already indicated by the earlier speakers. The situation is not hopeless. We should be able to go back to the core business. Core business, what are we set up to do as insurance companies, for instance? Just transfer of risk. So before these challenges in businesses were still existing. So assuming you don't have a way of addressing the existing challenges before this one coming in, How are you going to go about it? And these are some of the things that we should be able to do. The fact that we still remain relevant in the whole financial sector, we are still capable of introducing measures that will bring along our customers so that we all don't throw our arms in air crying over some of these things. So that is where I want to pitch it from. So going back there, what are the key areas that we need to look at? I expect insurance industry to come out with products that will support individuals, that will support corporate bodies, that will support players within the industry so that they can concentrate on their core business.
I see. So you're getting into the diversified approach to insurance. And I think that cuts across all the sectors, and we not doing the same things and expecting different results, trying to look at the flip side of this economic crisis and so on. But if we're going to build a robust securities industry, and all of you have roles in there, we cannot discount the importance of customer confidence, right? And this DDEP and other events that have come up, and you run through a few of them, Eugenia. Before the DDEP, we're dealing with the financial sector crisis and the impact, and then while we were recovering, we were hit with this one as well. How are you strategizing to restore customer confidence and improve on the confidence of customers as well to help build the robust sector that we want as a country? I'll start off with you.
Thank you so much. In the midst of challenges, opportunities are created. And that is where I want to come from. It is not going to be one-way approach. It is not going to be expected that you sit at your corner and have all the solutions. I expect regulators to be working with industry members. I don't think that prior to this challenge that we're facing came in, any regulator had in mind or had in the regulations how such situations are going to be addressed. But here we find ourselves. And definitely they are part of it. They are part of it in the sense that they are part of the solution. And therefore it is expected that together we work hard. There are some regulations that will have to be changed. Some will have to be enhanced upon. For instance, talk about what we count in terms of solvency. Investments that are counted solvency. I can speak for the insurance sector, for instance, where we don't put so much value on, say, investment properties. But prior to this, it was all about invest so much in government securities. So is it not about time we begin to look at other investment areas that are very robust, that will ensure that at least in the future we're not going to put all our eggs in one basket? Definitely this is something that the regulators will have to come in addressing this area. And I believe it's about also looking at other lucrative areas. We may not have them now, but what kind of investment can we go into in addressing social challenges? For instance, if we are mobilizing so much money and we have a challenge of, say, accommodation, housing problems, is it not about the time that the regulators looked at how we can invest in these areas that will also be counted in solvency without necessarily discounting them? I think these are some of the things that we should be doing. And of course, the product out there should also be lucrative enough to be able to attract, in terms of the stock market, in terms of products on the stock market, should be attractive enough and should be educated enough. There should be enough education so that everybody can come on board. For instance, if you're talking about traders on the stock market, we usually restrict them to only the educated, the elite, the formal sector. If you're talking about real money, somebody will tell you that they are sitting at Makola, they are sitting at KJTIA and those places. How many people at Makola are players in the stock market? I don't think that the case is about Ghanaians don't want investment, because if anything at all, the sponsor schemes have taught us that Ghanaians are interested in investment, except that they are not getting the right areas, they are not getting the right education. And therefore, I think that it's about time that as we're trying to address some of these challenges, we take up some of these things and address it.
I mean, the takeaway from the Ponzi schemes reference will be that you have a lot more interest-driven investors. I mean, the Ponzi's, it is the interest rate they use as a bait to get you to, which the formal institutions cannot offer. Are you with me? So how do you use that as justification for, the point that Ghanaians want to invest?
That is where I'm talking about the need for education. The fact that some interests are not realistic. And therefore, once the person is well educated about some of these things, and the person having some money to spend or to invest, because I know that there are some investments that one can conveniently go in and make better returns higher than the inflation without necessarily risking so much. So these are the areas that we should be looking at. Not too long ago, we were talking about, in Ghana, everybody's talking about roads. Our roads are bad. From Kumasi to Accra is so bad. Is it supposed to be only the government that should fix our roads? Is it possible that some investments can be pulled together from the private sector that will fix these roads and then charge?
So you put a toll booth on the road.
Exactly, and charge commercial rates. Until Zoom Lion, for instance, let me make reference. Until Zoom Lion, for instance, came to the scene, collection of refuse were the responsibilities of the state.
But you see, it's the first example, and I've sat through some fora that this has come up. You would have government consider that as against the public policy underlying factor of the cost element and looking at the public good. So even with the Tamamoto way that is supposed to be reconstructed and the tolls, remember when the Parliamentary Select Committee put out the charges, some of them are going to be increased by 50 pesos, 1 cedi. The kind of reaction that you get from the public, that this is too much. How do you then marry that against that proposal that, look, private sector can be put together for you to also invest in the delivery of public good, but charge commercial services for that to make your money back?
Thank you so much. I think it's about education and it's about convenience. For instance, if I'm traveling to Accra from Kumasi on a typical Sunday morning, say if I leave Kumasi around 6 a.m., within 2.5 hours, I'm in Accra. Why is it so? Because during that time of the day, there isn't so much traffic on the road. And you're able to make time savings. You're able to save fuel because you're not going to burn so much fuel. So you notice that at the end of the day, your cost will even be more without having the better roads we're talking about. So I think it's all about education. Continue to educate people and let them know, let them appreciate what they're going to earn at the end of the day, what they are giving off and what they are getting back. And I think it's doable because in the advanced countries or in some other parts of the world, these things are being done. If you don't want the speed or the properly built road, go and use the other one, but this one is for those who can pay. That's all. then we can move forward with some of these
Eugenia, I'll bring you in
ideas.
at this point as well on the diversification to the approach of investment, and then also the takeaways from this economic crisis that we find ourselves in to build this robust sector, the financial sector.
Okay, all right. So the recovery will require, as he rightfully said, education. Education, and it should be an effort, joint effort, regulators, industry players, we should all come together and push education to get people to understand. Then we need to be able to use technology to make information available, transparency. When it's more transparent, there's more confidence. If I understand the dynamics of what I'm investing in, it makes it easier. And today, thanks to technology, there's more information available in a structured form. When I used to be a broker, to get access to information was a challenge. And I remember there was one brokerage firm that was known in the market for having a very good library. So they had all the financial statements of the various listed companies. They had all the listing prospectuses. So you had to make sure you had a friend in that company. And when you want information, you call that friend, you send a dispatch rider to go and pick it for you, you photocopy, and then you send back. That's how cumbersome it was. But today, thanks to technology, at a click of a button, you have access to information. Even on the Ghana Stock Exchange, you go to their website, there's enough information available. We should make that more available. And it's so easy to diversify if you go through the Ghana Stock Exchange. Look, if you decide to invest in Mr. X, who has a fintech company, for example, all by yourself, you are carrying that risk all by yourself. But if we help Mr. X as intermediaries to bring that company to the market, then it means that I will invest probably just 10 cedis in it, somebody else invests another 10 cedis. If I lose that 10 cedis, it will not be as big for me as losing the big total capital he may require. Okay, so we need, as intermediaries, to be able to guide seekers of funds, hold their hands to bring them to the market, and also we need to be able to share information with those who have the funds to make them comfortable enough to be able to invest their funds into these enterprises. The days, as I said, of running to government treasury bills and government investments are over. We need to be able to come to the market with products that would attract pension funds, products that will attract other investors. And other economies have done it. Even here in Africa, you look in Kenya, South Africa, what have they used to develop their economies? Pension funds. We've seen some of those investments coming here into Ghana. Typical example that we can all see, for example, is Accra Mall. Accra Mall was built with funds that was put together by a private equity fund sitting somewhere else. Our pension funds today are valued at about $3 billion, Nana, if I'm right. 3 billion, I think, is familiar to us. That's what we've been struggling
to get from the IMF.
To get from IMF. We have it sitting here. The regulator has given us space to invest pension funds in alternative investments. What percentage of that have we used? We have space to invest in equities. So I can't even sit here and say we should get a regulator to increase the quota. Because what he has given us, we have not even used. Because we kept going back to say, can we do more government paper? Now we cannot do that again. We need to put our thinking caps on, show that we are investment bankers, and come up with products, and be able to channel resources to people who need it so that it can drive the growth of the real sector. And this is what will get us out of where we are today. Thank you.
Important point. Thank you. Thank you so much. Alan, so, I mean, look, financial literacy, I mean, I'll pick it up from there as well. It's generally low. But then, for you in the investment space as well, how can that be improved upon, especially because of what's happened now, and then also the other areas of investment, or generating or creating other areas of investment as against the existing ones, which have been a very comfortable go-to for a lot of the investment companies until now that we've had this rude awakening that we have to think outside the box. It cannot be business as usual. Alan.
Albert, I think for us, one thing is very clear, and we employ all investors to understand that markets go through a cycle. We are not at the end of our lives, not at all. We have just been at a situation where we've seen the lowest, probably in several years. But it doesn't mean this is the end of the story. The market will recover. And that's what we need to believe and accept. Because it's important to have that understanding. Else, we won't be able to see the recovery coming in. Then, in the area of investor education, I think one of the missing elements over the years has been the understanding of risk and overemphasis on products rather than letting investors know who they are when it comes to investments. So the client walks in, I want to invest. We have short-term investment, we have medium-term investment, we have long-term investment. Okay, I can wait for 5 years. Then the person invests. We fail to educate the client to understand his risk tolerance, his ability to take risk, and then 2, his willingness to take risk. And earlier on, you spoke about the Ponzi schemes. People are doing Ponzi schemes, yet they don't have the ability to take that kind of risk. So the guy runs away with the money, and that's all his life. He takes all his money and puts in the Ponzi scheme. When it goes down, everything is gone. So that mismatch and misunderstanding of risk is a lot of work for us to do, and we are embarking on that gradually, so that clients understand that the moment you decide to invest, there's risk. In fact, you have 2 options. You keep the money at home for the robbers to try and impact your life, or you put the money in an investment, and then you understand the risk with the investment. So whether you invest or not, there's risk. But what's important is understanding the risk you can take and making sure that your investment is in a risk that is affordable. Another way of looking at this is also, how much money do I have? And understanding that you cannot put all your money in one basket. You need to diversify. Earlier on, or prior to the domestic debt exchange, in fact, we've not spoken about savings account or fixed deposit, but it has a place. Invest. Leave some money in your savings account. No matter what, is easily accessible when you need that money. So spreading your investment across different investments will enable the client or the investors appreciate and go through the kind of times that we are currently in. And let me mention this one lastly. You know, we have different funds, different mutual funds. And most often, clients make the mistake by investing across different fund managers. That is not diversification. If the underlying investments that the fund managers are doing are the same, you have not diversified. You've only colored your investment differently. So he has investment in A, B, C, D. They are all doing Government of Ghana. Domestic debt exchange, it affects all of you. So it's important that clients understand the investment, and as investment professionals, we help them to see their risk tolerance and also the risk in the investments that they are doing.
And you see, also appreciate the fact that until now, a lot of the convincing by, you to clients or the public to invest has been a lot more on what they will get in terms of the benefit of the investment than the risks associated with it. Because I recall when this mark-to-market valuation started, and a lot of people will call TV stations and the media and say, we went there and they did, and I tell you know what, bring your contract, let me read it. And it is in there somewhere. You bury it silently, you don't tell the people. Now, when things come up and they are asking for their money, then you refer them to something that you did not tell them when they were taking the decision to invest. So, please, you two change your ways. Yeah. I mean, that's what I'm saying.
It's a lesson.
What I have here, improving customer confidence, is, for us acting, indeed, as a trusted fiduciary, for the longest time, we've placed, our interest above clients. And I think we need to apologize. profusely, to our client. It's all about gathering AUM and making our fees, irrespective of whether the product, meets the client need. And we really can't blame, the client, for that. We really, didn't act well. Secondly, to build, confidence, we really need to add ethically, right? Many of the challenges that has been spelled out was because we were just unethical. The crisis we went through, so-called reputable firms that were supposed to know better were just running Ponzi schemes.
Running Ponzi schemes?
Yes, we talk about, I'll mention the name, it's open out there, Men's Gold. Men's Gold wasn't the only Ponzi scheme. Asset managers were gathering assets, not because, they were competent, but because they could pay, the biggest bribe. Then we called it commission. So I'm the CFO of a company. I'll place money with company A, in as long as company A will give me 2-3% of the monies I'm placing with that asset manager. And that money is not mine. It's for my company. And that was a practice in the industry. We've been banned. It's been a crisis, but they say it is only a jerk who does not take advantage of a crisis. And I believe, going forward, we just have to be a responsible fiduciary. We need to be ethical. And there were good, firms over here. We knew what was happening in the market. We knew the rogue ones. And we remained silent, right? Hoping that they would implode and then we can gather the assets. If we had blown the whistle on them, perhaps the industry, would have been saved. So it is what it is. I guess now we know, that there's no free lunch when it comes to investment, again, on the back of the mark-to-market, discussions. We've rightly, peddled return, not giving, due consideration to risk. And indeed, every investment in this world, even treasury bills, comes with market risk. Because if you buy, treasury bills today as an investor, yourself, matures in 91 days. Something happens, you need your money in 30 days. You may have to sell. And the price at which you sell will be different from the expected value. So every investment comes with risk. And I guess, going forward, we as fiduciary need to emphasize risk hand in hand with the potential, return. It is only Bernard Madoff, Netflix, that can give you a return that slopes, 45-degree angle. If you see that, run away. Run away.
Thank you so much, Jifa. And then we'll come to the audience right after Jifa. So, we have a largely informal economy. I think that Edward mentioned that the penetration of the insurance sector is not that much within in the informal sector. And then you have all of this that has happened as well, which impacts on customer confidence to deal with. How are you also going to put the necessary measures in place to improve on the penetration of the insurance sector, not only in the formal sector, but the informal sector especially, as well as also diversifying the approach to selling insurance?
Thank you. So as in insurance, we've been hit with confidence issues. Over the years, our customers haven't trusted us that much. A lot has been done in the industry. In the last 2 years, we have embarked on a lot of education and getting customers to trust in us. We had gained some mileage prior to this happening again. This is no fault of insurers. It's a general thing that has happened in the economy. And so together with our regulators, education is very key. We're going to continue as an industry educating the public about the benefits of insurance. And when it comes to claims, we are going to be very transparent with our customers. I believe that any company in difficulty due to this DDEP would have the assistance of the regulator. The government has promised some assistance. And so I believe the communication is very, very key. And then onto the untapped markets. We're going to be employing a lot of technology, which we started doing already to reach the uninsured population. We're trying to simplify our products as much as possible, also with the help of the fintechs, to be able to insure a lot more people, to bring a lot more people into the pool. So insurance, it's a pool. The bigger the pool, the better, it is. And so we are poised. We are not giving up. We are not raising our hands. Yes, it has happened, but I believe that the industry collectively will come together and rise above the challenges and offer our customers the best.
Wonderful. Please, let's put our hands together for the panel. Great submissions indeed. So we'll go to the audience now. You can put up your hand. I think there are 2 microphones. Walk up to them, mention your name, and then please proceed with your questions. Yes, I saw a hand here. No, you can walk to the microphone. Thank you. Then, yes. There should be another one here as well, so the next person can stand behind the microphone on the other side. Yes, thank you.
All right, can you hear me?
Yes, clearly.
Thank you. My name is Mulenga Brian Matale with Aguilar Capital. We're a Canadian investment bank with an African focus. The way we normally work is obviously attracting international capital into countries like Ghana. We just did a transaction in January, and we have a couple more at work that should be closing in the next couple of months. So I've kind of latched on to what the asset managers had spoken about with respect to their allocation for alternative investments, which is kind of where we've made our bread and butter. And it's a lot of private credit funds in the UK, Europe, etc., that attract money into this market. So I understand you have an allocation of funding that you can play that way. What is attractive to you that the same opportunities we're presenting to these funds outside of the country that we can put in front of you? Will you actually invest, and what it is about those investments would make sense for you? Because in most African markets where we participate, we do find, of course, really why we have a business is because of the inertia in the local markets by way of whether it's regulatory limitations or a lack of innovation or just that reticence to want to participate. And I do sense that a little bit in the local market. And speaking to my local peers, I don't know of anybody who's been able to tap the pools of capital that you have at your disposal. So for us, the question is, okay, if I have those kind of investments that are attractive to non-Ghanaian firms that are looking to invest, if I bring the same opportunities to you, is that a waste of time, or will you actually seriously consider that and deploy some capital?
Okay, thank you. Yes, you can answer that. We'll go to the next one, please.
All right. So thank you very much, for the question. So yes, indeed, the pension, law allows us to allocate monies to private equity funds. And I think we have, room to do up to 15%, also. There's also room for external investment. And I guess, private equity firms domiciled, outside or registered outside will count within the external investment opportunity set. At Access, we have been very, deliberate about private equity. Together with our fund manager, Stambek, I think we may have been the first pension fund, to foray into private equity. Obviously, those private equities are domiciled in Ghana, registered in Ghana. That doesn't end there. We are still, looking for opportunities. What do we look out for? We look at the track record, of the GP. We look at and the track record even includes the profile of the people behind the GP. It is the people's, business. And also the opportunity set. Once the opportunity set, makes, sense, we can get, some considerable, returns. Why not? The only challenge, it is possible, to invest if your fund is domiciled outside, but it takes a longer time to convince, the regulator and some of the fund managers along, that journey. But we are very, open to that. We are currently doing due diligence, on 2 funds that are domiciled in Mauritius that have approached us. We like their story. We like what they've done in the past. And if we are able to cross all the regulatory hurdles, we will definitely back them. It also gives us an opportunity to diversify our funds outside of Ghana risk, right? The CD indeed hasn't been a good store of value. Anybody who throws, me an asset in USD that is expected to generate, good return, I would definitely back. Thank you.
Thank you. Alan.
Just add a bit. So for fund managers, we advise the owners of money, which are the pension schemes, the employer-sponsored scheme trustees, as well as the corporate trustees. It is important to appreciate the fact that government of Ghana is no longer as risk-free as we thought it was. That realization then puts the owners of pensions to realize that it's important for us to diversify. If you look at the pensions report for 2021, SNIT had about 20% in listed equities and about 27% in unlisted equities. And guess how much they had in government of Ghana bonds? It's about 7%. So all the noise about DDE, SNIT will not cry because they only had 7%. If you come to pension schemes, tier 2 plus tier 3, they hold about 85% government of Ghana bonds. So definitely they will feel the pinch much more than SNIT. And what has happened has opened up the conversation, and we are still engaging, that trustees will begin to understand that it is very important that we diversify the pension assets and look at these alternatives which will help develop the economy. The developed markets have not gotten it all right from day one. They lost some money, but the lessons day after day have brought them where they are. Kenya, Nigeria, they all have allocations into equities upwards of 20. But Ghana, as we speak, pensions per the 2021 records had less than 2%. In fact, 2020 was about 4%, and 2021 is less than 2%. So these conversations, and thanks to BFT, education, when you meet your trustee as an employer, ask them, how much are they allowing fund managers to put into the real sector, into do alternatives, so that together we can create these assets that will help develop the economy. We talked earlier on about infrastructure, but the question is, it's not really about the cost of the infrastructure. It is the return comparatives. If there's an infrastructure fund that will do the Temamoto way, and we are going to get a return of 15% on it for the next 30 years, no pension fund manager or pension scheme will invest. Why? Treasury bills is giving you 19%, 20%, and he's not sweating. But if Treasury bill rates were 5%, what option do you have? It's important that we agree to reset our interest rates as an economy so that the alternatives become very attractive. And if you want to beat inflation, preserve the value of your investments, then you look at options beyond Treasury bills and fixed deposits.
Great stuff. Thank you so much. Please.
Do I have to do something? Okay.
We can hear you.
My name is Wisdom Anku. I'm with Pro Partners. My question is going to push you a little to the corner. Looking at what has happened so far, and particularly with the discussions so far, you would see that the regulators have been greatly complicit in all that we are experiencing today. Ghana is not an island. There is what we call best practices. My question would be, are our regulators giving us the best of services? Are we getting the best compared to what happens in other civilized societies? Thank you.
This corner, I mean, this corner that you put this before, I hope there are no representatives of the various regulators here. Who is a rep from SEC? Bank of Ghana? They are not here, please. You are free to go. Yes. They are watching it live. Please, let's block them.
I think
Anyway. Yes. Let me start off with Edward, then to you, Eugenia,
Well,
please.
that sounds interesting. But you see, regulators don't regulate in a vacuum. They use regulations in regulating. And regulations are put up based on existing situations. And therefore, at any point in time, whatever regulations that are being used to regulate us as players on the market were done considering the situation at the time. That is why along the line was suggesting that we rather ensure that moving forward, regulations would consider how to react to unexpected situations and be able to change. After all, nothing remains the same forever. But it's about how you react when changes occur. That, for me, is what matters. And therefore, I would propose that regulators have a look at some of these things and study the situations regularly in addressing some of these challenges moving forward in the future.
Thank you.
I don't think you can blame them so much because nobody anticipated that. And you see, one thing with regulators is that they are always so much interested in protecting the investor, but not the institution where the investment is made. That is their interest foremost. So always thinking about how would the public be protected. And I'm sure that is what has guided them over the period in fashioning out regulations that are regulating us. So moving forward, there will be the need to do something different.
Edward, we understand. Your regulator will be happy with you. But you see, the reality, if you say that, nobody saw this coming, I think some of us will disagree with you. But I can understand if you say the regulator wasn't proactive and all. That's fine. It's nice language. We have been a politician. It's okay. But the reality is that, look, we know what could have been done. Okay? Eugenia.
I think similarly, I would say that some of those regulations were in place because at that time, that is what the market required. For example, you had a new pension industry. We were now going into private pensions for the first time. Regulation was now being set up. So if you suddenly open the market and say, fund managers, you can invest in anything, there would have been chaos. So regulators needed to do it gradually. So they started with almost 100% in government paper, and then gradually they kept reducing. Yes, we should all have been a bit more proactive. We should have seen that that is not the best way to develop the economy. But I think the regulators have been listening.
Right.
And they've been more cooperative. They have set up mechanisms that make it more easy to bring innovation to the market. So we've all learned from what has happened. And I think going forward, working with the regulators, we should be able to avoid some of these things.
Great. Thank you so much. Please.
Thank you very much for the opportunity. My name is Eric. In one of Mr. Boame's responses, he suggested that the owners of the funds are the trustees of the various pension schemes. I beg to differ. The owners of the funds are the market women, the security men who are making their contributions in the case of insurance, the policy holders, okay, how do you explain mark-to-market to the market woman? How do you explain mark-to-market to a security man who wants to secure his pensions? I am hoping that by the end of this summit, I will get some good answers for these categories of people. Thank you.
Thank you. Yes, Alan.
Yes. So you're right. The trustees play a fiduciary role when it comes to the pension assets, and that's why I said they are the owners, but the underlying owners are the contributors who put money into the various schemes that the trustees oversee and have a responsibility to ensure its safety and then growth. When it comes to mark-to-market in our investor education, this is how I simply put it. I go out to buy oranges at 50 cedis, and then I have to sell the oranges to make profits. The worst I will sell the orange is at 50. I won't make any profit. Then we are okay. But if I sell the orange at 30 cedis, it means that there's a loss of 20 cedis that somebody will have to pick. So in the same way, the investment that you have with us, we hold it at 50 cedis. If you want to withdraw your money and we go and sell to take money to pay you, that 50 cedis, we will only get 30 cedis from it. And therefore, when you come and you want your money, it is impossible for us to pay you 50 cedis because what we got from the market was 30 cedis. In fact, if we pay you 50, then we're becoming prophetic and we're taking other people's money to pay you. So it's an uncomfortable conversation, but that's the reality of the situation. And all we can ask is for clients or investors to forbear with the current environment. And if you don't really need the money, if it is not critical, we'd say endure, let the markets recover. Then you go ahead and make your redemptions.
Okay, is that clear enough? Can you go to the market woman with this one? That would help.
Oh yes. Okay. So going forward, I mean, in some of the fund manager space, what we have done is to ring fence new deposits, so that the new deposits don't suffer the market volatilities because they are not invested in any of the bonds. So yes, but it is not to say there's no risk. Let's understand, because if your new money has been used to buy treasury bills, and treasury bills are not honored by the government, you still have some risk. So we still say, understand where your money is going. If you are not comfortable, don't put the money there, so that you are not surprised. There are funds that are not doing treasury bills, so you can put it in there, understand what they are putting the money in, so that you are not surprised tomorrow when you ask for your money.
Okay. Joa?
So when it comes to insurance claims, for insurers, we don't have the luxury of any mark-to-market. Once the event crystallizes and we've insured you, we are expected to indemnify you in full. And so when we go to the market to liquidate our investments, and we have the mark-to-market conditions, it still doesn't exonerate us from indemnifying you in full. So I just want to bring this up for you to see the extent to which we are exposed.
Wow. So then you will still have carry the burden of making full payment, even though the investments that you have made on behalf of the clients is suffering a haircut.
Exactly.
Okay. That's serious. Please.
Thank you. My name is Bernardo Wuswedu. This question, I have two questions. I think it goes to the insurance industry. The first question, I would like to start from where Jifa ended. I know as an insurance industry, you have your revenue. That's the income that you take principally from the premiums that are paid by the insurers. Then out of your revenue, you have what we call reinsurances, which you pay if you have. Then you have your commissions, which you pay, if any. Then you have claims, which you cannot foretell because it happens at any point in time. Then you have your management expenses, which you have to look at. And then other expenses. If you have any capital expenditure that you are also undertaking, you have to take from this same revenue. Now, the question is, you have made a budget for the year. The budget which you have made will make room for all these things, but the claims you cannot foretell, so you also make room for it.
Right.
Now, in instances whereby a claim has emanated to the extent that it subsumes even the revenue that you have been able to generate. I know insurance is about trust and confidence. And in an economy where we are saying that insurance contributes to not more than 2%
To GDP, by the way.
to GDP, how are you able to go about fulfilling the claims of claimants in instances whereby you need to even boost the confidence in an economy of ours like this? How are you managing it in these times that we find ourselves?
Is that one question?
That's one question.
Wow. That's anyway. No, the second question has to be in 30 seconds. Please,
Yeah,
because-
very,
yes,
that
thank
will be
you.
very short. Now, the second question is, I know that as an insurance industry, there are instances whereby you have to reinsure some of the businesses. Now, I'm talking about the need for you to see the need for collaboration. I know we are in a very competitive industry, but I think collaboration is key.
So what's the question?
So the question is, there are instances whereby businesses are placed, but the businesses that are placed, we find it being reinsured outside of Ghana.
Okay.
So if we have an industry whereby we can be collaborative,
Right.
why don't you insure the businesses here and
keep
hold all the money here in Ghana?
I agree
Thank you.
with you. Thank you. Now, did you attend University of Cape Coast? I mean, because you people. Anyway, but look, it's not a question; it's a contribution. Honestly, I did get the question, but yes, maybe the both of you. Yes, Edward. Okay. If yours is on, you can start, and then Edward. Yes.
Okay, thank you very much for your question. Starting from your last comments, we collaborate a lot as an industry. We share risk among ourselves. And even as part of the regulatory requirement, you cannot seed any risk out without exhausting local capacity. And so, yes, there are some nature of businesses that the market may not have enough risk appetite to take. And we can't compel colleagues to take on such risk. And so usually the practice is to interest the local market, ensure that people can take to their capacity. And mind you, the level of risk we can assume as an insurance company has a bearing on our capital level. So if I'm going to assume a risk that should it crystallize, all my capital will be wiped out in one instance, I would be cautious. I would be measured in what I take. So that's one of the reasons why sometimes we seed businesses out, but we need to seek the regulator's approval first. And then on to the other question, the first question of how do we pay claims? We are in the business of paying claims. And over time, whilst in business, we accumulate a lot of funds. We don't just spend everything we accumulate within a period. And so, yes, we do investments and we rely on these funds to pay our liabilities when they crystallize. You mentioned reinsurances too. Where we have reinsured to other companies, reinsurance companies are oftentimes more solid or are supposed to be more solid than insurance companies. And so we fall on them, and together we're able to pay you.
Right on. Thank you. Edward.
I can perceive that the gentleman is within the insurance industry.
Obviously.
Anyway, insurance is a technical subject, and it's about insurance companies taking risk and managing the risk. So it's about how the risk is managed. That is how come he's talking about reinsurance, co-insurances here and there. But to begin with, insurance premiums, or somebody will say pricing of the insurance products, are done scientifically. You don't just introduce a product and say that I'm going to charge that much for the product. He made mention of some items that goes into that. And the real risk is based on some data. I'm not an actuary by profession, but let me share how they go about it. It's based on the data for a long period of time as to occurrences. So they're able to determine that if you pick this risk for every particular year, this is the number of events that will happen so far as that risk is concerned. And that becomes basis. Then they will load it, expense loading, they will load management, they will load for marketing commissions as you indicated, and they will even load for profit. So at the end of the day, yes, the risk may occur or materialize, but the projections made scientifically may not be too much different from that. But beyond that is where we also put in place the reinsurance and the co-insurance arrangements, such that in the event of any risk materializing, your co-insurers or your reinsurers will also come in to settle in part of the risk. Apart from the fact that you might have also accumulated investment over the period. And let's also not forget about the fact that we are required to work with certain minimum capital so that in the worst case scenario, you can fall on some of these arrangements in place. Right. So that is how we manage the risk. Now, the case of insuring some businesses outside, even though you may have the financial capacity to underwrite the total business, but you may not have the technical capacity. You know, some risks are occurring for the first time. For instance, when did Ghana start with the exploration of oil? Not too long ago. So this is a risk, for instance, that we were not used to. It will take us some time to build the capacity and to build the enough funds to be able to take so much of that risk or maintain so much of that risk internally.
Okay.
Let me seize this opportunity to talk about the penetration, which is so low. Yes, it is so low, but it is also important that in talking about penetration, we look at what goes into measurement of insurance in our country. Elsewhere, if we talk about insurance, their social security is part of it.
True.
Elsewhere, their health insurance is part of it. Their pensions is part of it. But over here, they are all measured separately. I'm not by that saying that insurance industry is doing well. No, that is not what I'm saying. But I want to at least seize this opportunity to correct that erroneous impression. But they need to work harder. And how do we go about it? Again, I have spoken about collaboration
Yeah.
with the various financial services in terms of product development. So that if, for instance, an investor is going to invest in money, in an investment house, that investment purpose should not be to take the money for funeral. So that investment house can collaborate to have a funeral policy added.
Great.
So that in the event of the person being bereaved, that portion, the investment will still remain intact. So these are some of the things that...
Fantastic.
Thank you.
Thank you. Eugenia, I'll give you the last word. We're rounding up the conversation. Finally, please.
Thank you. So I think our discussion was supposed to be on how to be able to achieve sustainable economic development. What are the things we need to look at? And as we've said, we have the opportunity with what has happened to reset the economy. So we have the opportunity to do it right, okay? Now, how do we achieve sustainable economic development? What are some of the things we are looking at? Infrastructure development. We need to be conscious of the environment, the social impact, health, governance issues. How do we do this? We need patient capital. Where is that going to come from? It's not going to come from short-term loans, fixed deposits. It's going to come from the capital market. So we need, as market players, to be able to come up with a product that will enable the holders of funds channel funds to the parts of the economy where it is required and can lead to sustainable development. We need to be supported by the macroeconomy, government policies. For example, if government decides that now the exemption on capital gains tax has been waived and is coming back, that does not help market development. Yes, it's been in place for a long time, but have we reached the goals we set for ourselves? The reasons why we exempted capital gains from being taxed, are we there yet? If we are not, why are we not continuing with the exemptions? So these are some of the things, the regulatory aspects. Then as players, we need to play our role, and we should be able to drive capital to the right places to be able to achieve sustainable economic development.
Fantastic. Thank you so much. Thank you, Eugenia. Thank you, Edward. To you, Nana Kwabena. Thank you so much. And also Jifa. Please, let's put our hands together for them. Thank you. Thank you. So we're going to take a photograph, right, for the memories and publication, please. Yes.
And thank you so much, Alfred, also for moderating this conversation to a success. We'll take the group photograph, and then right after that, we will be having our closing remarks from Dr. Daniel Enim Prempe. He is the Director of Operations at the Business and Financial Times. Once again, I would like to acknowledge our sponsors, Stanbic Bank, Aza Finance, FBN Bank, Glyco, GCB Bank PLC, and to our global our media partners. We have Global Media Alliance, City FM, City TV, TV3, Onia FM, Asasi Radio, and Happy FM. And thank you all so much as well. Don't forget to download the to give us the closing remarks. And please, when we close, do not be in a hurry to leave. We will be having lunch, and then after that, I'm sure we can network further over there. Dr. Neem. Lunch will happen at the Ghanaian village near the beach. So don't be in a hurry to leave. And then we'll take a group picture with everybody present. Dr. Neem.
Thank you, Baba, for a very wonderful. Yes, on behalf of Team BFT, we would like to express our gratitude for you participating in today's event. We are equally grateful for our sponsors. By virtue of their kind sponsorship, we're able to put up this program. We equally thank the speakers for a very thought-provoking, insightful discussion. We also would like to thank delegates that are here. Your contributions are well, thought-provoking, and it will add up to knowledge and also professional discourse development going forward. Team BFT would like to indicate that this platform is not just a one-shop event. The discussion goes on and on. We'll make sure that with issues that have been discussed here will further be discussed further and will be laid before regulators and policymakers for onward policy formulation in view of developing the economy of this country. I wouldn't like to take much of your time. Once again, on behalf of our board chair who is here, Dr. Edith Dankwa, Mrs. and Team BFT, we say, Ayoko, we are grateful for your time. We are grateful for your presence. And we hope the next time you are invited, you will make time to participate in our event. God bless all of us, and thank you very much. You take over. I should pray also. Okay. I've been instructed and directed to give the closing prayer. I think I started it, so shall we, this time around, let's be on our feet as we ask. Heavenly Father, we thank you so much. We called on thee from the beginning, and by your gracious mercies, indeed, you've seen us through. Even as we are living here, we commit our lives into thy hand. We pray that you command your angels to lead and to direct us. We trust and we also pray for this nation, that by your mercies, you will help us develop this nation and create opportunities for our citizens. Heavenly Father, we pray, oh Lord, that even as we are living here, you command your blood that speaks better things than the blood of Abel, that cry for vengeance, to be with each and every one here. We thank you and we bless you in Jesus' name. Amen. I'm done, right?
Yes.
Okay.
Thank you.